Good afternoon. हाँ सबने चाय पी है समझ में आ रहा है आवाज से. So welcome you all on DTRC session, and today's topic is of charitable trust, and we are here our speaker CA Ravi Gupta ji. Actually the speaker we have called fall sick, and we contacted CA Ravi Gupta ji today morning only, and I want to thank him that he accepted our invitation and agreed to deliver the lecture in such a short span of time. So please, sir, thank you. Now we have our CCM, CA Dheeraj Khandelwal ji also here. I request him to say a few words. Sir, please.
Once again, welcome to each and everyone. My colleague in the council and my dear friend and one of the finest speaker on the taxation, on the accounting standards, and the chairman of the ASB Accounting Standard Board, Pramod Jain. I welcome Pramod Jain over here. So let's have the welcome the Pramod Jain, and we all Western region people always love to hear you on the various taxation parts and number of topics, and we have already listened your number of viral video on the taxation aspects. And the honorable chairman of this vibrant region, Murtuza Kanchwala, of course office bearer Sweta Jain, Pinky Kedia, Ketan Sayya, and again I can say it's the last wall which he is going to take a entire session is none other than Ravi Gupta ji. Let's have a big loud applause for him, because he's the only person in the I came to know about just few hours before that he contacted today morning. One of the speaker could not able to join today, and immediately he accepted. And I'm telling you very frankly, he's one of the authority, I can say it's in this particular subjects. He is practicing from last 20 years. After being in the big four, he was in, I think, EY or EY. He was in the EY, he was practicing there, worked there, and then after he started to practice, and constantly, from last 15 to 17 years, working in this particular area. And I'm sure about it, and you will not disappoint it. He will going to touch each and every aspects of the taxation. And I'm not a expert in this particular field, and I was taking the help of the Pramod Jain because he's the expert. And I always said that what to brief, and he's brilliantly guided me. Look, this is a opportunities for the members, and the opportunity is for the practicing in the charity world, practicing in all the fields of content which is the charitable trust is going to required, or charity is going to required. And he explained that the why it is required, and there's in which format it should be done it, and what is the criteria should be there. There are confusion across the board, and the clients always been in with dilemma whether to form a Section 8 company, or whether to form a society, or whether to form a trust. And everywhere you have to design a concept, what step need to be done it. For the taxation purpose, definitely taxation comes in the last, and for that you need to have a registration of either of the trust, or either of the society, or either of the Section 8 company. Then after you have to apply for the charitable organization, charitable trust. In Mumbai, there's a Maharashtra charitable trust is there. Likewise, the state charitable trust is there. Society, after that, you have to register for the society trust also there. Even for the Section 8 company, you have to apply for the charities. Everywhere you have to apply. Then this is also important aspects. Taxation is the same for each and every aspect, all the organization, all the concepts. Now, Once you have to be applied, you have to see that which section you have to be seeing, what the object going to be there, whether section 1023C or whether it's a 12A. And I can say that most of the people choose the 12A because 1023C only provides two major aspects of the education and healthcare. And if vice versa in 12A, you can cover each and every aspects, all the, whether it's a donation given or expenditure on any aspects of the charity, which can be covered, whether the CSR, taking donation, everything can be covered in 12A. So format is main important. What the format need to be great. So that's important aspect. And people are specialized in this particular area, and we should guide to our all clients. And then it's a taxation aspects come, and that when the taxation aspects come, and we have seen in the last 3 years, all the financial year from last consecutive to 2021, 21, 22 or previous, there's a lot of amendments. And across the world, everywhere it's seen that, previously used to be a charitable organization, what the funda going to be there. Now it's completely changed. Every aspect you have to, whether the 500 rupees expenditure on the more than that, you have recovering previously is 20,000 rupees. A lot of things, amendments being incorporated in the charitable trust. And that's why our Ravi ji is here to brief all the amendments and integrity and discuss the way forward. And you are very free feel to ask as many questions. Don't just be limited yourself to listen his deliveries. Let's have interactive aspects. And I'm telling you, he's very good in the interaction, and he will deliver all the, all of your queries. So that's interaction makes everything is easy. Maybe he will learn and you will also learn. So both together we can find a good solution. With this, once again, I welcome all of you to this particular program, and also request Ravi ji to take this particular session. Before that, so before that, I request Pinky to take this session.
Thank you, Dheeraj, for your inputs. We are fortunate we have our one CCM, CA Pramod Jain ji with us. So we don't want to miss the opportunity to hear him. Yes. Sir, please say some few words, please.
Thank you, Chairman, sir. I'm a very, very dear friend and a Central Council member from your region, CA Dheeraj Khandelwalji, the chairperson of WIRC, Murtazaji, Secretary Shwetaji, Pinky Ketanji, and the speaker for the day, CA Ravi Gupta ji, who promptly assisted, I would say, own fellow members, because the speaker who had to come had certain medical issues, so he could not come. So really, this is the way our chartered accountant friends help each other. Thank you, Ravi ji, because we are all together only. So really, thank you, sir.
I just want to read the one issue over here. The same thing. We were in the 2009 in the Goa, and where the RRC was there for IFRS. And one of the speakers in the last night could not able to, he refused in the last night itself. And they were RRC, and we were having the Goa in 2009. And how it going to be, held, who going to take this particular session. In the night itself, the speaker said, I could not able to come from Mumbai. I have the family emergency. My wife got sudden issues, and I could not come. And the last day was the, only the session of him, Rakesh Agarwal. Now he's in Reliance. Then we thought, what to do it. To very frankly, there was among the participants, one person, Desai was there, Yagnesh Desai. Now he's a speaker. He's the, discovery on the 2009 when he was among the participants. And we asked them who can take it. We identified two people who's taking the maximum questions. Okay, and he's more participative. And into the 9, there's 2 person were there, and out of 2, we choose them and requested him. No, no, it says, how I can be here for learning? How I can be a speaker? And how can we can, brief the all people? We requested that these are the issues are there. Then entire night, I'm telling you, 2 people, we kept 40 people. Entire night, the Rakesh Agarwal briefed each and everything and, studied them together entire night. 6 hours they sat together and briefed the each and every point. They said, this is my presentation. You just run this presentation, and these what are the questions I can be asked. And then after he took the first, lectures, exactly decide into the 9, and then now he's becoming good speaker. So that the things members always try to help each other.
And your own CCM Dheeraj Khandelwalji, if I talk about, because he has been contributing to our fraternity for the last more than 16 years. He is my senior in the council, third year, term in the council. So this is his first year in the third term. That is his 6th, 7th year. Fortunately, he has been my chairperson of one of the very, very important committees. And this year also he is a chairperson of that committee. And that committee is committee for the MSME and startups. That committee was formed under his chairmanship. And the work which has been done for the MSME and the startups is really remarkable. Only a person like Dheeraj could have brought that committee to this level that it has been appreciated by all government agencies, by all members. Really, sir, great work, Dheeraj bhai. Great work. Thank you. And he's also being, I know him for 2 things, though he's doing for WTO also, but this committee for MSME and startups, and second is for the public local accounting bodies. He organized one of the programs. He brought municipal agencies throughout the country at one place and had a great session. Thousands and thousands of people were there. It was in Delhi. So I was one of the panelists out there. And we were talking about various items like accrual system, cash system, double accounting system. So he has made really inroads into municipality and all those things. So courtesy to all Dheeraj bhai for looking into all these areas, sir. Thank you, sir. I'll not speak much on the topic because Dheeraj bhai has just very rightly guided to choose either of the 3 entities where the role of a chartered accountant would come, and then register with the State Charity Act. But the issue is that certain times these clients don't come to chartered accountants and they feel that we have registered a Section 8 company or a charitable society or a charitable trust. We have registered under the Charity Act of the Maharashtra. So we are getting income tax exemption. It is not that way. Any of these 3, they will have to further get the registration which Ravi ji would be taking. I'm not going into all this taxation of 12 and 1023C. Just one point, in case they don't register, then what? Then we all are seeing that in case of Section 8 company, of course, ITR 6 is to be filed. Otherwise, ITR 5 will be going. And then any amount which is received by them as a donation, voluntary contribution, the whole amount is taxable. If you see the CPC, they make an addition and none of the expenditures are being allowed because they are not registered under 12 or 10. Their income is not exempt. And the basic concept under income tax for income from other sources, that the expenditure should be incurred for the purpose of earning that income. Please understand that is the donation earned expenditure incurred to earn that donation? No. So under 57, it is not allowed. So one has to be very clear in guiding the members according to that. I'll not take much time all to Ravi ji. Thank you. Thank you for inviting me again here. Thank you very much.
Thank you, Pramod ji, for your input. And definitely, I think CA Ravi ji will take these questions and this topic in his presentation. And now I want to request CA Ketan Sayya to formally introduce today's speaker, CA Ravi ji, please.
respected Central Council member Dheeraj Bhai, Pramod Bhai, Honorable Chairman of Western India Regional Council Murtuza Bhai, Secretary Shweta Madam, my colleague in Council Pinky Madam, seniors and friends. It's a privilege to introduce a very, very knowledgeable speaker, CA Ravi B Gupta. Ravi ji has done BCom, is a FCA and also cleared insolvency professional exam. Ravi ji has been the partner in Ravi B Gupta and Company for more than 25 years. He has rendered the services into the formation of charitable trust, society, Section 8 companies. He's also occupied in audit and assurance, taxation services. Also, he handles the financial planning and taxation work relating to the financial planning. He also does the project appraisal and project planning. He is also involved into the RERA organization and RERA registration compliances work. Ravi ji has been the member of the Cooperative Section Society Committee of Western India Regional Council in 2021. He is currently an active member of the Insolvency Study Group Core Committee of ICAI for the current year, that is 22-23. He speaks on various topics, including charitable trust, compliances, the FCRA, the specific act under which the foreign donations are received. He is a regular speaker on CSR activities. He is also a versatile speaker on an offbeat topic like self-help and positive mental attitude. Ravi ji has been, very, very active into the various activities of Institute, including he is one of the contributor to the Western India Regional Council's reference manual. He is one of the contributor for past several years. He has also done a training of CNAG officers on the taxation of charitable trust. Friend, I'm sure this 1.5 hour, we are going to have a very good discussion on the topic of charitable trust. And Ravi ji, we are really thankful to you at Western India Regional Council for accepting our invitation at such a short notice and gracing the occasion. And I request all the participants to welcome him with a loud round of applause. Over to you, Pinky.
Now I request our CCM CA Dheeraj Khandelwal to present a memento to our today's speaker. Now CA Ravi ji, dais is yours, please.
Hello. Thank you.
Good evening, friends. At the very outset, I would thank WIRC for giving me this opportunity. And I would like to make a special mention of how I am here today for this session. Murtuza sir called me up in the morning at 8:30. So I was thinking that how the committee members, how the council members are working so hard and how they are contributing to the betterment of the profession. In me accepting the invitation to deliver today's subject is not that important, but how the council members are contributing, how they are putting in so much of effort for the benefit of the members. That is really commendable. And that is why I would request all the attendees, participants to give a big round of applause for the council first. I recognize the presence of two CCM members today, Mr. Pramod Jain and Mr. Dheeraj Khandelwal, my very close friend. And then Mr. Murtuza, the secretary, Shweta Jain, Pinky Ji Kedia, and Mr. Ketan Sayya, and my lot of my senior friends, colleagues, my professional brothers, and all the participants today who have come here to enrich themselves or other exchange views on the subject of charitable trust, which is nowadays becoming day by day, I would not say confusing, but of course it is a challenging subject nowadays because of the amendments in the last consecutive 3 years, right from Finance Act 2020, Finance Act 2021, and Finance Act 2022. Lot many changes have been introduced just to see that the trusts function in a proper way and the compliances are being done in the proper way as the revenue department or the income tax department wants them to do. So now, without taking much time, because I feel the time allotted to me, the subject is very vast, and time allotted to me, I think I will do justice in whatever the time is allotted to me. So we will come straight away to the subject. My PPT, I believe, is visible to everybody. I have shared it with WIRC also, just in case if anybody is interested. I mean, they can take it from the WIRC. So I will start with the subject right away. हेलो कर्सर शायद मूव नहीं हो रहा है. So these are the sections which are of relevance as far as charitable trusts are concerned. Basically starting from section 215, 1023C, 11, 12, 12A. Of course, 12AA is now replaced with 12AB. Section 13 includes section 13.7, which talks about anonymous donation. 13.7 read with section 115 BBC. Then we talk about section 115 BBI, section 271 AAE. This is the new section which have been introduced now. Section 8IG, which everybody is aware. Then section 234G, these are the penalty and late fee sections, sections 234G, 271K, 115 TD, TETF, again the accredited income. 143.3, this is the new amendment now from the Finance Act 2022. Last but not the least, section 164.2, 164.3, read with section 167B. This is the concern which just now the CCM, Mr. Pramod Jain, talked about, that if you are not registered under section 12A, what will be the scenario? So I will cover this sections, and definitely if the members have got any queries on these subjects, I will definitely take up all the queries. Thank you so much. Coming to section 215, this is a very basic section. This section talks about the definition of charitable purpose. Everybody has to be very clear about what is a charitable purpose. And it is an inclusive definition. It has been changed, that the items have been added day in, day out, I would say, or other yoga, like yoga was added in 2015. Then we had preservation of environment added later on. Then preservation of monuments added later on. Earlier, there were 4 limbs: relief of poor, education, medical relief, and the residual section. Now in all, we have got 7 limbs. So some important pointers as far as section 215 is concerned. The definition of charitable purpose is inclusive, as I told you. All the limbs of section 215 are not mutually exclusive. They may overlap. Now, what does this mean? Now, suppose if you are sponsoring an education of a student, in that case, you are doing relief of poor as well as promoting education. So it may overlap. That is what it means. A purpose must, in order to be charitable, be directed to the benefit of community or a section of community, as distinguished from an individual. Many times it so happens that this particular, you may come across an organization which is formed for a particular set of people, for a particular caste community. So is that allowed? Benefiting an entire community is included under the charitable purpose definition. The purpose should not be directed towards one individual or a group of small individuals, or to further improvise for a charitable purpose to be charitable purpose, to be treated as a charitable purpose. The list of beneficiaries should be always a fluctuating body. It should not be a stagnant list of beneficiaries. In that case, it becomes a family or a private trust, you may call it. So these are the important pointers. And one more very important thing, we should not, think that we have to provide free services. It is not necessary for a charitable organization to provide free services. A charitable organization may provide services at subsidized rates. And why not free services? There is one more reason. If we do not have the required resources, how will you run the charitable activities? Charitable activities ke liye bhi paisa chahiye. So that is the reason that it is not necessary to provide free services. Very important proviso added from the financial year in the Finance Act 2008. What does this proviso say? Now, from the assessment year 16-17 onwards, the limits defined in the proviso has been changed. Now, what are the fresh limits? The fresh limits say that if out of the total receipts which an organization earns or receives during a financial year, if 20% of that amount is, or more than 20% of that amount is generated or earned by commercial activities, in that case, your trust will not be treated as a charitable trust. In other words, suppose if you have a total donation of say 1 crore, and out of that donation receipts, whatever income on your income side, if the total receipts is 1 crore, and out of that 1 crore, you are generating 25 lakhs from a business or a commercial activity. In that case, your trust will lose the fabric of a charitable trust. It will not be treated as a charitable trust. So that is what this proviso means. The earlier this limits were different. Now, from the assessment year 16-17 onwards, this limit has changed to 20% of the entire receipts. Of course, there are certain case laws which will throw more light on it. I have just mentioned the case laws for the benefit of the participants. I'm not going through all the case laws. Coming to section 1023C. Now, majorly, as Mr. Pramod Jain said, that Dheeraj ji has made a mention of this. 1023C section is what? 1023C section, when we are concerned with 1023C, we majorly talk about 1023C 3AB, 3AC, 3AD, 3AE, 6 and 6A. Now, when we talk about 3AB and 3AC, now 3AB and 3AC are the organizations where the funding of the government is more than 50%. When we talk about 3AD and 3AE, these are the charitable organizations where the turnover is less than 5 crores. Now, both these types of organizations are exempt from tax. The organizations substantially funded by the government, as well as the organizations whereby the limit of turnover or the receipt during the financial year is 5 crore or less than 5 crore. And the third type that we are talking about, 6 and 6A, are the organizations which are neither substantially funded by the government, nor the turnover is less than 5 or 5 crores. The turnover is more than 5 crores. These two types, or here the educational organizations and the medical organizations falling under 6 and 6A have to apply for registration to the PCIT or the CIT, as the case may be. They have to get themselves approved so that they can avail the deduction or the exemption from income tax. So this is majorly 1023C, 3AB, 3AE, 3AB, 3AC, 3AD, 3AE, 6 and 6A. And majorly talking about educational institutes and medical institutes. So this is 1023C, and a lot of changes have been brought into 1023C because earlier 1023C organizations, as far as the income tax provisions were concerned, were not at par with organizations registered under section 12A. So via these amendments, the government has tried to remove the differences between these two types of organizations. There were various differences. I will deal with all those differences. Now, this 5 crore limit we have already discussed. Now, earlier, for example, the audit provisions were not defined as far as 1023C organizations are concerned. Now, the audit provisions have been made clear as far as 12A organizations also and 1023C organizations also. Now, we have the due date for filing the return is October 31st, and the audit report has to be obtained 1 month in advance. That is by the 30th of September. So this one thing as far as 1023C concerns this is the latest amendments. Earlier, the audit report dates were not defined. So what used to happen is the audit reports were filed late. Sometimes the audit reports were filed after the return was filed. So that is why there were many reasons whereby, substantial tax liabilities were raised on the charitable organizations. Earlier, of course, 1023C, 3AD and 3AE. Earlier, the limit was 1 crore. Now, which has been revised to 5 crores. Now, one major change as far as 1023C is concerned brought in by the Finance Act 2020 is the registration process, which everybody may be aware of. In the Finance Act 2020, the registration process has been totally revamped. Totally. It is totally new now. The window was open for 21-20 during the period 1st April 2021 to 31st March 2022. In that period, the organizations which are already approved under Section 1023C had to reapply again, reapprove the organization again for a period of 5 years. That is from 21-22 to 25-26. So that was one change. Then the entire process of approval is changed now. Every 5 years, you have to renew the organization. Every 5 years, you have to apply to the income tax department, prove your credentials, and then only you will be renewed for the next 5 years. One very important change again is about the provisional approval and provisional registration. 1023C organizations, you can avail provisional approval. What is provisional approval? Suppose you are approaching the income tax department for the first time for this approval. In that case, earlier, I will try to take you back to the earlier situation so that you can make a comparison. Earlier, what used to happen when we went with an application to the income tax department, the income tax department would always say what all activities has been conducted by the trust till now. If you have not done any activities, how can we grant you the permission or how can we grant you the approval? We, from the side of the SSC, used to contend, sir, first give us the registration, first give us the approval so that we can start the activities. So to remove that ambiguity, what the department has done now, they have come up with the concept of provisional registration. This provisional registration will be granted for a period of 3 years. And the provisional registration has to be converted to a regular registration, and the time limits have been given for that. What are the time limits? Within 6 months from the date when you start the activities of the trust, or 6 months prior to the expiry of the provisional registration, whichever is earlier, sorry. Now, suppose if your trust is already into activities and you can, from 6 months from now, in that case, you have to apply for your approval. You are already doing the activities from, for example, we are in July now. So you have to make an application before January for regular registration. Thereby, your provisional registration will be converted to a registration of 5 years. The registration of 3 years will be converted to a registration of 5 years. Now, suppose the activities have not begun. If you are beginning the activity, if the activities are starting, say, after 6 months, then 6 months from that, within 6 months from that date, you have to apply for the regular registration. So this concept has been brought in by these amendments now, so that you can go for your provisional registration also. Now, the advantage of this being, that you get the provisional registration also very fast. The time limit given is, suppose if you're applying in the month of July, you will get your provisional registration by the end of August. 1 month from the end of the month in which the application is made. So you will get your registration by August and you can start your activities. I've talked about the audit part. Now, this is the chart which I have prepared as far as the registration process is concerned. Now, the very first clause is no more relevant because the due date, the applications have become time barred now. Many a times we do receive queries that suppose if the registered trust has not re-registered or re-approved under the first clause, in that case, what remedy do we have? I'm afraid we do not have any remedy. The earlier 12A registration or the 1023 registration is lapsed in that case. We will have to apply fresh and we will get a provisional registration which has to be converted to a regular registration. Then after 5 years, I've already talked about that we have to, after the end of say 4.5 years, we have to apply for the registration for the next 5 years. And at that time, our case will be scrutinized and that scrutiny will be done by the relevant the jurisdictional AO, ITO exemptions. Earlier, the way earlier also the ITO used to do the scrutiny. Now also they will do it for the next 5 years. Provisional registration to regular registration we have dealt with, and the fresh registrations we have already dealt with. So this chart is very handy. You can refer it. All the time limits are given. Now, certain fresh amendments by the Finance Bill 2022. Finance Bill 2022, very landmark amendment under clause 5. If property held under trust includes any temple, mosque, gurudwara, church, or other place notified under 8IG 2B, any sum received as voluntary contribution for purpose of repairs or renovation may at the discretion of the trust be treated as forming part of the corpus, subject to conditions. Now, this is a very landmark change whereby the trust is given the authority to treat a particular donation as a corpus donation. Now, anybody can throw some light that why this amendment must have been brought. One possible instance which I can see, this has been effective from 1/4/2021. One possible thing which I can see is the construction of Ram Janmabhoomi. From 1/4/2021, they started the collection from 1/4/2020, after 1/4/2021. And the construction is going to continue for the forthcoming like 2 to 3 years. So that is what I believe that this may be the reason that this amendment has been brought in. But of course, there are certain conditions to be met. And those conditions are corpus to be applied for purpose for which it is received. No deduction to be made to, no donation to be made to any other person. Corpus should be separately identifiable and to be invested as per section 11(5). These are the conditions which have to be met to avail of this facility. And explanation 1B again introduced the consequences of not meeting these conditions. The income will become taxable in the year in which the violation has occurred. Specified date for order, lot of changes. Specified date for passing the order defined within 6 months from the end of the quarter in which the first notice was issued. This is talking about 143(3). When we come to 143(3), we will deal with this specified time. Specified violation has been defined. Earlier, it was not defined. I'm not going through the definition. Explanation 3. If no action is taken on the reference, if the reference has been made by the income tax officer to the Commissioner of Income Tax regarding some charitable trust, and if that application was pending on 1/4/2022, the time limit of 6 months will be considered from 1/4/2022 for disposal of that particular reference. Prescribed authority has been defined. Institution, one more amendment, institution cannot take simultaneous benefit under section 1023C and 1046. If the institution is approved under section 1023C and is notified under section 1046, the approval granted under section 1023C shall become inoperative. There was some confusion earlier that under section 139(4)(a), the due date for filing the return has been defined, and if the return is not filed by the due date, we got certain assessments from the income tax department. We got certain intimations saying, since you have violated the due date of filing the return, you will be denied the exemption under section 11, 12, or 1023C, as the case may be. But there was a mistake. That mistake was rectified earlier. That mistake was rectified later on, because the time limit given by the Income Tax Act is the end of the assessment year. You can file the returns up till the end of the assessment year. If you are filing the returns till the end of the assessment year, you will be in a position to avail the benefits of section 11 and 12 or 1023C, as the case may be. Now, one more very important amendment: surplus to be taxed after allowing expenditure. Earlier, this was not the case. Earlier, if the exemption is denied, the entire gross income was taxed. Now they have made an amendment that suppose if you are not registered, in that case, certain expenditures will be allowed against your income, and the net and the surplus after that will be put to tax. Certain things now 1023C organization TDS provisions were not defined earlier. Now TDS provisions have been made applicable to 1023C organizations also. So that is how they are bringing the 1023C organization at par with the 12A organizations. Now, one more that is a important amendment, I would say. Earlier, if the income was debited to your profit, and if the expense was debited to your profit and income and expenditure account as money spent towards the objects of the trust, but actually the money was not paid, in that case, it was allowed as a deduction. It was allowed as an expenditure towards the objects of the trust, to be precise. Now, what they are saying is suppose if you have booked an expense, you will not be allowed to treat it as an application towards the objects of the trust till the amount is actually paid. Now, suppose if you are booking an expense in 21-22 and you are actually paying in the financial year 22-23, in that case, the expense will be treated as an expense in the financial year 22-23 and not in 21-22. So that is a very big change. Now, coming to section 11.1. What is section 11.1? Everybody is aware. Section 11.1 talks about the application, the 15% statutory deduction, which is available to organizations registered under section 12A. Whatever is your income earned, less 85%, remaining 15% can be accumulated for perpetuity. That is what section 11.1A and 11.1B talks about. 11.1B earlier was, what does 11.1B says? It is no more relevant because it was applicable for trusts which are partly charitable and partly non-charitable. Nowadays, such trusts are not recognized by the Income Tax Department. So wholly charitable trusts are recognized for the purpose of section 11.1. Budget 2021 brought one change, that if the amount is spent from loans and advances, suppose if you are spending some money, if you do not have the resources, if you have to borrow that amount from the trustees or maybe not non-trustees, in that case, the amount will be treated as application towards the objects of the trust only when the loan is repaid. Because otherwise, earlier there were deficit income and expenditure account. Suppose if you have received say 1 crore and you have spent 1.5 crores and 50 lakhs you have borrowed from your trustee or say non-trustees for that matter, the deficit was 50 lakhs. But nowadays, what they are saying is, suppose if you are spending that 50 lakhs after borrowings, that amount cannot be treated as application towards the objects of the trust. It will be treated as application towards the objects of the trust when you repay the loan. So this is the budget 2021 amendment. 11.1C. What does 11.1C says? Income applied on activities outside India is not eligible for exemption unless certain conditions have been mentioned. many a times I've come across whereby the Charity Commissioner Office says that if you have a clause which says that the amount will be spent on activities outside India, they refuse to register the trust. So at that time, we should always put up your case before the Charity Commissioner saying that 11(1)(c) says that you can spend your money in activities outside India subject to conditions. So if we do not mention that clause in the constitutional document, how we can apply the money outside India on the projects which are recognized by the central government? So we should insist them that let us put this clause, because one fine morning when you want to spend the money on projects outside India, how you will be in a position to spend that amount. So I have dealt with this point over here. 11(1)(d). What is 11(1)(d)? Everybody knows: corpus donation, voluntary contributions received in the form with a specific direction saying that this fund should form part of the corpus fund are exempt from tax. These are capital receipts of your organizations, right? And there is one more case law which I would like to throw some light on. If the Honorable Court has decided that if there is a direction saying that this fund should form part of the corpus fund, this fund has to be invested in as per the mode specified in section 11(5), and the income or interest generated from that investment will also form part of the corpus fund. Such directions are also allowed. In that case, suppose if somebody is contributing and saying, I am contributing X amount towards the corpus of the fund, and the interest accrued on this amount will also form part of the corpus fund, that is also allowed as a corpus fund. So whenever the interest accrues on that, that can be straight away transferred to your corpus fund. Certain case laws and very important points I have mentioned. I'm coming to the one more amendment which has been brought by the Finance Bill 2021. Just now we discussed about loans and borrowings. Similar is the case with corpus donations. Suppose if you want to spend money towards the objects of the trust, your income is insufficient, there is some money lying in the corpus fund. You may utilize that amount from the corpus fund, but the amount utilized from the corpus fund will be treated as application towards the objects of the trust only when that amount is compensated back to the corpus fund. Earlier, it was not so. And because it was not so, earlier, there were cases which were resulting into erosion of corpus fund. So now, to check that erosion of corpus fund, this amendment has been brought into. Other conditions for availing deductions: trust is registered with Commissioner of Income Tax under 12(a)(b), and books are audited as per section 12(a)(1)(b). That we will deal with later on. Explanations: I will explain the explanations with a practical example. Suppose if you are receiving a donation on 31st of March or any income on the 31st of March, obviously you will not be in a position to spend that amount towards the objects of the trust. That may lead to a surplus which may put the organization to tax. But of course, that money has come for the object. That money may have come to meet the objects, or meet the project expenses of the projects to be taken up in the next financial year. In that case, you can make an application in form number 9A to the Income Tax Department saying that this is the amount which we have received during this financial year, and we are not in a position to apply this amount in this particular financial year. So please allow us to spend this money in the next financial year. So that is allowed. You have to file form number 9A, and it is just an intimation. The Income Tax Department, there is no provision in the Income Tax Department whereby the department says that they will verify the form which has been submitted by you. So it is just an intimation. So form number 9A can, and similarly, there is one more condition. You may book an income. You may say that this is the income accrued to us, but we have not received it. So in that case also, you can file form number 9A and you can tell them that we will spend this money in the financial year in which the money is either received or in the next previous year from the year in which the income has received. So these are the explanations. This is a very good explanation which the department has given to the charitable trust, because otherwise you will end up paying taxes. Now, form number 9A has been made, e-filing of form number 9A has been made mandatory from the assessment year 16-17. 16-17, and many a times, in many cases we have seen whereby the form number 9A was either not filed or it was filed late. And because it is a new provision and it is a new process, the department very rightly considered the point that if the form has been filed delayed, in that case, the delay can be condoned by the PCIT or the CIT as the case may be. And that is specifically for the assessment year 16-17, 17-18 and 18-19. So wherever, if you have certain cases whereby there is a delay in filing form number 9A, you can get your delay condoned. You can make an application to the PCIT. You can file a petition saying due to so and so reasons, we could not file the form number 9A. So please condone our delay. So this is applicable to 9A also in form number 10, which we'll be dealing later on. Restrictive amendment by Finance Act 2017 for assessment for financial year 17, from financial year 17-18 onwards, any trust or NGO availing tax exemption benefit under section 11 or 1023C shall not be allowed to treat corpus donation. What is this amendment? If you are making a corpus donation from one charitable organization to another charitable organization, it will not be treated as an application towards the objects of the trust. Only amount donated, general donation, which we may call it. We may not say that any corpus donation given from one charitable organization to another charitable organization will not be treated as application towards the objects of the trust. Earlier, this situation was different. Even if a corpus donation is made from one charitable organization to another charitable organization, it will be treated as it used to be treated as application of funds towards the objects of the trust. Of course, this was a loophole, this was a lacuna, which has been plugged in from financial year 17-18 onwards. TDS. If TDS is to be deducted and a charitable organization has not deducted TDS, in that case, 30% of the expense will be disallowed. Any expense above 10,000 made otherwise than through banking channels will be disallowed. Budget 2021, one more amendment, no set off or deduction or allowance of excess application of any of the year preceding the previous year shall be allowed. Now, what does this say? Earlier, there were judicial pronouncements whereby carry forward of deficit of one particular previous year was allowed to be adjusted against the income of the subsequent previous year. There were judicial pronouncements. So this was leading to a lot of confusion. So by the budget 2021, this confusion has been removed now. You cannot carry over the deficit and adjust the deficit towards the income of the subsequent previous year. Same amendment related to section 11. We talked about the amount, the donation which can be treated as corpus donation discretionarily by the charitable organization. Same amendment in section 11 also. We have already dealt with. Some important case laws for your reference. 11(1)(a). 11(1)(a), the amount of exemption in relation to capital gain arising on transfer of capital asset. Now, as far as section 11(1)(a) is concerned, I am dealing with many trusts whereby I have not come across a situation whereby we have to calculate capital gain. We follow a very simple methodology. As far as section 11(1)(a) is concerned, what we do is, if we sell an asset, we book the entire income in the income. We credit that income in the income and expenditure account. And when we purchase the asset, we debit it to the income and expenditure account. Because as you all know, capital expenditures are allowed to be debited to the income and expenditure account in totality. So in that case, what happens is, it is very simple. Otherwise, calculation of capital gain as far as charitable organizations is a very difficult task. And this is a very practical approach. Then too, if there is a situation whereby you have to calculate capital gain, you can follow the formulas laid down by section 11(1)(a). And there are many judicial pronouncements which also say that it is not necessary to purchase a capital asset from the sale proceeds of a capital asset. For example, if you are selling a immobile property, it is not necessary that you purchase a immobile property. Even if you are investing that money in the modes specified in section 11(5), will do justice. So this is about section 11(1)(a). 11(1)(b) talks about the consequences whereby you have accumulated the money by filing form number 9(a) to be applied in the subsequent previous year, or as the case may be in the case of accrued income in the year in which it is received. These are the consequences. Now, 11(1)(b) says that if you violate those conditions, in that case, the income will become taxable in the year when the violation has occurred. And if there is a violation, you have to pay the taxes at maximum marginal rate, and you need not apply 85% of that out of that amount because you have already paid the taxes. So this is section 11(1)(b). Section 11(2), again, it's a very good section. It allows the charitable organizations to accumulate money over a period of not more than 5 years, so that that money can be spent towards the objects of the trust, which are having huge expenditures. And the trust, in many a times, it so happens that you have a big project and the entire money cannot be accumulated in one particular year. In that case, you can accumulate this money over a period of 5 years, and you can spend that money in a period of 5 years. Earlier, due to section 11(3), the situation was such that the Income Tax Act was giving a provision of, say, 6 years. But now that anomaly has been removed, taken care of. 11(3) has been amended. Now, strictly, now suppose in the year 21-22, you are accumulating certain amount under section 11(2). That amount can be accumulated for a period of 5 years. Now the 5 years period will expire on 23, 24, 25, 27. So by the end of the year 26-27, financial year 26-27, you have to utilize the amount towards the objects for which the amount has been accumulated. Now, when you accumulate this amount, you have to file form number 10. File form number 10, and with the mention of the objects for which the amount has been accumulated. So that is very important. You have to mention the objects for which the amount has been accumulated. You have to pass the necessary resolutions, and the Income Tax Department may call for verification of those resolutions. But of course, the amount should be accumulated for a period of not more than 5 years. Declaration has to be made in form number 10. Various case laws. Again, form number 10 ka, likewise in the case of form number 9(a), form number 10 was mandatory. E-filing of form number 10 was made mandatory from the assessment year 16-17. Now, in that case also, there were many occasions whereby the people forgot to file form number 10, or they filed it delayed. In that case also, the department, after due representations, they have allowed for the delay to be condoned for the assessment year 16-17, 17-18, 18-19 by respective circulars. Now, coming to section 11(3), exemption of section 11(2) withdrawn if specific conditions not satisfied. What are those conditions? If the money is applied or applied for some other purpose, ceases to remain invested as per section 11(5), not utilized for purpose which is so accumulated, is donated to any trust registered under section 12AA. The amount cannot be donated to another trust. It has to be utilized for the purpose for which the amount has been accumulated. Amendment of section 11 by the Finance Bill 2022, 11(3). This is what I was talking about. Now, how does it read? Earlier, section 11(2) provided a 5-year period for accumulation, but by virtue of section 11(3), the penal proceedings were attracted only after the expiry of 6th year. In other words, a grace period of 1 year was provided by the Act for utilization of income accumulated under section 11(2). This issue has been dealt with in the Finance Bill 2022. From now on, the unutilized amount accumulated under section 11.2 shall become taxable in the last previous year of the period for which the income is accumulated. 11.3a, modifications are possible. You may write to the income tax department saying that due to so and so conditions, the amount which was accumulated for a particular purpose, that purpose is difficult to achieve now. You have to justify how it has become difficult to achieve. In that case, the department, after due scrutiny and looking into the merits of the case, may allow you to use the money so accumulated for some other purpose, which is also covered by a constitutional document, that may be the trust deed or the memorandum of association. 11.3 gives you that leeway. You can apply to the income tax department. 4 and 4a. Now 4 and 4a is business undertaking. Talks about business undertaking. There are many organizations, many charitable trusts who are running business undertakings. So the taxation of business undertakings is defined by section 11.4 and 11.4a. The entire income is included in your income and expenditure account, and accordingly, then we have to apply the 20% ka funda which we discussed in the proviso of section 215. So this is about 11.4 and 4a. Many case laws have been mentioned. 11.5 talks about the modes. This is a very exhaustive list. These are the modes in which you can invest your money which is accumulated under various sections of your organization. Of late, stock certificate as defined by Sovereign Gold Bonds Scheme 2015 has been added. Now, one more very important thing, if there is a violation of section 11.5, suppose if you have invested your money in, say, some Pathpedi or some cooperative credit society, in that case, the income generated from that investment will be treated as violation of section 11.5, and the income generated from that investment itself only will be taxed at maximum marginal rate. Not the entire income will be put to tax at maximum marginal rate. So the case laws have been decided on this particular subject, and I have mentioned those case laws. Section 11.6, very important section. Section 11.6 says that if you have purchased an asset and the cost of the entire asset has been debited to your income and expenditure account, in that case, you will not be allowed to claim depreciation of that particular asset, and very rightly so, because this will tantamount to double deduction. Earlier, of course, it was allowed, but now it is not allowed. If you are debiting the cost of the entire capital asset to your income and expenditure account, the depreciation on the same will not be allowed. So this is what section 11.6 talks about. And this amendment has been brought by the Finance Act number 2, 2014. Finance number 2 Act 2014. 11.7. One earlier 11.7 used, there was a provision whereby you could either claim deduction under section 12A or you can claim deduction under section 1023C. How this used to work? Practically, suppose if you are running an educational institute, if you are not registered under section 12A, so definitely you will not be allowed deduction under section 12A. People used to claim deduction under section 1023C 3AD if the turnover was less than 1 crore earlier. But now this has been taken care of by an amendment which has brought into section 11.7, and you can now either claim deduction under section 1023C or you can claim deduction under section 12A. You cannot claim deduction either or. You have to be specific under what section you can claim the deduction. So this is about section 11.7. Again, 11.7, there is one more amendment. Any sum payable by the trust shall be treated as application only in the previous year in which the payment is actually made. This we have already discussed. Section 12 talks about voluntary contribution. So there are two types of income in your organization. One is income from property held under charitable trust, and that property includes your business undertaking also. And section 12 talks about the voluntary contribution. In the common parlance, we talk about donations. If you receive donations, that is defined under section 12. If you receive income from a property held under trust, that is defined under section 11. So these are the two sections. When we are referring to 11 and 12, this is the difference between the two sections. 12A, everybody is aware what is 12A. 12A gives your organization exemption from tax. It authorizes you to take 15% standard deduction, subject to the conditions mentioned therein. So I'm not going into much detail as far as 12A is concerned. Certain case laws I have mentioned. Very recently, by the Finance Act 2020, a section 12A1AC has been introduced. Now, what is that 12A1AC? Again, the re-registration process, the provisional registration process. Of course, in 12A, there are two more possibilities. One possibility is suppose if you are changing the objects of the trust, or if you are changing the conditions under which you have been granted 12A. If those conditions are changed within 30 days, you have to apply for a fresh 12A. That is one more additional thing which has been added. I will take you to the chart first. Yeah. Then one more possibility is registration of trust has become inoperative due to approval under section 1023C. Suppose if your 12A has become inoperative because you have registered your trust under section 1023C, but you again want to take your registration under section 12A, you have to apply afresh, and the time limits have been given for that. These are the two more possibilities which have been added. I'm not going into the time limits. Of course, when we take the question answer session, if there is some specific challenge, if the participants are facing as far as registration and re-registration is concerned, we will deal with it at that time. Audit of accounts has been made compulsory now. Audit report, the time limits have been defined for audit report. The maintaining of books of accounts will be prescribed very soon. What all books of accounts are required to be maintained, because that is also one more amendment in the Finance Bill 2022. The books of accounts and other documents have been kept and maintained in such form and manner and at such places as may be prescribed. So this prescription will soon come. 12A2 talks about the effectivity of your 12A registration. Suppose if you are registered in say 2015, your 12A registration was first obtained in the year 2015. You are re-registering that 12A registration. You must have re-registered by applying in the financial year 21-22. In that case, your trust will be treated as 12A registered right from the first year, that is 2015 itself. So that is what section 12A2 talks about. One very important point, I mean, in all my discourses, I generally tell people that these are the 6 clauses which you need to mention in your constitutional document. Because many a times, as we just now heard, that there are many chartered accountants who are not into the practice of charity commissioner, as far as we talk about Maharashtra. Or there are many people who are just registering their trust and they are not complying with the income tax formalities. In that case, I would recommend that whenever you are coming up with a charitable organization, and if you want to register your trust with a charity commissioner, these 6 clauses are very important. What are those 6 clauses? The irrevocability clause, beneficiary clause, dissolution clause, a clause that the funds and property of the trust institution will be used only for objectives of the trust institution, utilization clause you may call it, amendment alteration clause, and investment clause. You should mention that the amount which is accumulated in the charitable organization will be invested as prescribed by section 11(5) of the Income Tax Act. So these are the 6 clauses which I recommend each and every constitutional document should contain. Otherwise, when we go for registration or when we go for hearing before the Income Tax Department for renewal later on, when we will be scrutinized, at that time it will be a challenge. And if they point out that the absence of these particular clauses, the remedy which we have is we have to again go to the charity commissioner. We have to rectify your constitutional document, which is a very lengthy process, and then again go back to the Income Tax Department for the 12A registration. So right from the formation itself, we have to be very careful. 12AB, procedure for fresh registration. I think we have talked enough about the 12AB registration, the time limits have been mentioned. Now, of course, re-registration process is out of question. It is time barred now. Provisional registration, the time limit is 1 month from the end of the month in which the application is made, you will definitely get the registration. We have seen in our practical experience, if you are applying within, generally in most of the cases, we have got the registration within 4 weeks. So the process is online, everything is online. The only thing is when we go for, now when they call us for scrutiny, of course, we may have to go and visit to the income tax department. 12AB has been replaced, 12AA has been replaced by 12AB. The procedure is defined. Now, one more very important change which this amendment has brought is suppose if the organization has not complied under any other act. Suppose if there is, say, Companies Act 2013 is applicable to you, or the Maharashtra Public Trust Act 1950 is applicable to you. In that case, you have to be very careful with the compliances under other acts also. Otherwise, the Principal Commissioner of Income Tax or the Commissioner of Income Tax may withdraw your 12A registration because you have not complied under any other act. A similar amendment has been brought into by the Maharashtra Public Trust Act also and the Societies Registration Act also, whereby if you are not complying under any other act, your registration with the Charity Commissioner may be withdrawn. A lot of case laws have been mentioned. Again, this chart, one more very important thing, I have mentioned the forms in the last column. For what purpose you have to apply, what forms, apply in what form, and the resultant order will flow into you in what form. Very recently, I came across a case whereby a charitable organization approached me and they told me that, sir, we have not applied for re-registration. We were under the impression that we have to make an application in form number 10B, the application for which is extended up to 30th of September. But in his case, because the trust was already registered under section 12A, form number 10A had to be submitted. So now after 31st March 2022, there is no remedy. The earlier 12A will be treated as cancelled and they will have to apply afresh and they will get a provisional registration. And as per the time limits, they have to again apply for the regular registration, which will be converted from 3 years to 5 years. Now again, amendments in Finance Bill 2022. Principal Commissioner or Commissioner to take cognizance of specified violations. Specified violation is defined. Specified date, the Principal Commissioner has to pass the order within 6 months from the end of the quarter in which the reference or has been made or the notice has been issued by the Principal Commissioner himself. Specified violation defined again. This is the chart how section 11 and section 12 looks like. What is 11.1D, 11.1 ABC? This is a flow chart. So it will give you a bird's eye view. Now coming to section 13, what does section 13 say? Denial, withdrawal of exemption. What circumstances? Income applied for private religious purpose, income of charitable trust institution applied for benefit of a particular religious community or caste. Income applied for benefit of specified person. Specified person is defined in section 13.3. Funds invested or deposited otherwise than the modes mentioned specified in section 11.5. So these are the positions whereby the exemption under section 11 and 12 will be withdrawn. 13.2. 13.2 are the circumstances which define that these are the circumstances whereby it will be treated that you have applied the amounts otherwise than prescribed. Like for example, any part of the income or property of the trust or institution is lent without charging adequate rent or compensation. What does this mean? Suppose if a charitable organization has got a property and they are lending that property and they are giving the property on rent to a specified person without adequate rent or without rent. In that case, it is a violation of section 13 and exemption under section 11 and 12 will be disallowed. 13.3 defines your specified person. So this is the definition. 13.4, exemption shall not be denied. Now, suppose if a trust is making an investment in a business entity whereby the specified person has got a majority stake. This particular situation is dealt by section 13.4. But of course, if the investment is less than 5% of the total capital of the business entity, in that case, it will not be treated as a violation. So this is 13.4. Now 13.6, if you are running an educational institute, or if you are running a hospital or a medical institute, in that case, if services are provided to specified person, only that portion of the benefit which is given to the specified person will be included in the income, will be calculated and will be treated as the income of the organization, and it will be added to your income. Only that portion. The entire exemption will not be disallowed because you are running those organizations. If the specified person is taking the benefit, it is allowed by the Act under section 13.6. This is an exception. 13.7, anonymous donation. 115 BBC, read 13.7 read with 115 BBC. Limits have been prescribed. 5% of the total donation or 1 lakh rupees, whichever is higher. Anything above that will be treated as anonymous donation and will be put to tax at maximum marginal rate. This is what anonymous donation talks about. 115 BBC. Many case laws have been decided whereby temples, for example, you may come across many cases whereby temples are receiving donations, anonymous donations through donation boxes. There are many judicial pronouncements whereby the honorable courts have allowed such donations, and those donations were not treated as anonymous donations. Because the intent of the law by introducing 115 BBC is to tax unscrupulous practices, whereby, black cow white and all those things were happening. So 115 BBC was introduced to put a check on that. Whereas as far as hospitals are, whereas temples are concerned, the small donations which are received through donation boxes are very genuine donations. So those cannot be put to tax by saying that it is anonymous donation. Those judicial pronouncements have been mentioned in my slides. Section 13.8. Taking you back to the proviso to section 215, 13.8 says that only in the year in which the proviso to section 215 is violated, only in that year you will be denied the deduction under section 11 and 12. Suppose if you are complying with the limits in the next financial year, in that case, you will be treated as an organization registered under section 12A, and the deduction under section 11 and 12 will be given to you. Why this 13.8 proviso has been introduced? Suppose if you violate the charitable purpose ka definition, in that case, your trust will, ideally it should lose your 12A registration, and then the sections 115 TD, TETF will flow in, putting the trust to huge taxes. So that is why the 13.8 has been introduced, and 13.8 says that only when there is violation of the proviso to section 215, only in that case the deduction under section 11 and 12 will be disallowed. Otherwise, your trust will be treated as a charitable trust. 13.9. 13.9 is a section which says that if you are accumulating your income under section 11.2, that is accumulation for a period not more than 5 years. In that case, you have to file the returns on the due dates. For example, if your trust is audited, in that case, you have to file the returns by 31st of October. You have to get the audit report by 30th September. If you are violating those dates, in that case, the accumulation under section 11.2 will be disallowed to you. Similar is not the case with 9A. In the case of 9A, you can file form number 9A till the end of the assessment year. So 13.9 has specifically mentioned that in the cases of 11.2, you have to abide by the due dates of filing the returns. Amendments, again, most of the amendments which we have covered when we were talking about 1023C. New section 115 BBI by the Finance Act 2022. What does this section say? It is proposed to tax the specified income at the rate of 30% in the hands of the trust institution without allowing any deduction of expenditure. Specified income has been defined. What is specified income? These, according to this definition, if you are falling under this particular section 115 BBI, the entire income, which is your specified income, will be put to tax at maximum marginal rate. And 115 BBI will have an overriding effect over anything contrary. 164(2), for example. We will talk about 164(2) in the last slide. Amendment by the Finance Bill 2022 again. The Finance Bill Lok Sabha has inserted proviso to existing proviso of section 56(2)(10). Now earlier, if a charitable organization was giving money to persons, in that case it was allowed, it was not put to tax. But now this amendment says that if a charitable organization registered under the Society Registration Act or the Maharashtra Public Act is giving amounts to specified persons, in that case, that income will be taxed. So this is the amendment which has been brought in by the Finance Bill 2022. Proposed new section 271 AAE. Now it is no more proposed. This is a mistake. I will rectify it. Where the income of the trust institution is applied for the direct or indirect benefit of specified person. Under section 13(3), 100% of penalty will be levied on first violation and 200% will be levied on the second violation. Any amount which is spent for the benefit of the specified person, as defined under section 13(3). So this is a very important section to be. 8IG, not talking much about 8IG. Everybody is aware 8IG, there are not much amendments except the re-registration part, which we have already covered when we covered 1023C and 12A. The only thing which I would like to mention over here is donations over and above 2,000 rupees in cash. Any donations in excess of 2,000 in cash, you cannot claim deduction. The donor cannot claim deduction. Of course, the trust can issue receipts for any amount. If they receive, say, 10,000 in cash, the trust can issue the receipt. But the donor will get the deduction only to the extent of rupees 2,000. Again, chart 234G, lot of people must have faced challenges regarding 10 BD, form number 10 BD. Related to that, section 234G says late fee of rupees 200, similar to DDS returns. If there is a delay in filing returns or delay in filing form number 10 BD, 200 rupees per day will be the late fee, which will be charged, and another lump sum penalty of not less than 10,000 up to a maximum of 1 lakh rupees, 271K. Not talking much about 115 TD, TF, accreted income. 143(3) by the Finance Bill 2022, where the AO is satisfied that any trust or institution has committed any specific violation as defined above, he shall make a reference to the PCIT. Now the PCIT has to pass the order within 6 months from the end of the quarter in which the reference has been received. And once the PCIT passes the order, he has to convey the order to the assessing officer. And after receiving the order from the PCIT only, the assessing officer is supposed to pass the order. And that time limit of 6 months, 8 months, as far as the AO is concerned, he will be granted an extension of that time, which is used by the PCIT to pass the order. So this is what 143(3) talks about. Now, coming to the most important thing, 164(2), 164(3), vis-a-vis 167B. Now, according to these sections, I would humbly like to, we had a small discussion earlier when the session started, that how should we deal with organizations which are not registered under section 12. First and foremost, I have studied this subject very nicely. And I would like to tell you all that if it is a charitable trust, the return has to be invariably submitted in ITR 7. First and foremost, the return has to be invariably submitted in ITR 7. Then there are case laws which say that even if the trust is not registered under Section 12A, the income has to be calculated on a commercial basis. This case law was decided, this judgment had, I think the judgment is KMR Educational Society. It had come way back in 2011, whereby it says that expenses have to be allowed on commercial principles. Of course, you must have received many intimations whereby if you're not registered under Section 12A, your gross receipts are put to tax at maximum marginal rate. Why they are put to tax at maximum marginal rate? Because they are invoking Section 167B. But 167B gives a specific exemption to organizations registered under Societies Registration Act and similar acts. What do you mean by similar acts? You may call it Maharashtra Public Trust Act 1950. So 167B specifically excludes those organizations. So in my humble opinion, even if the trust is not registered under Section 12A, the taxation applicable to individuals has to be applied. The expenses have to be allowed, and the net income has to be put to tax and not at maximum marginal rate again. So a combined study of 164(2)(3) and 167B. But of course, this is the position of the law. But till now, we are also receiving many intimations, many orders, whereby if the organization is not registered under Section 12A, the gross receipts are put to tax at the maximum marginal rate. But if such is the case, we have to take up the matter with the Income Tax Department. I have been successful in getting many orders rectified after explaining the positions of what is mentioned in the law. Not outside the law, but of course in the law, we have been given these provisions. So this is about 164(2) and 3. The relevant case laws, I have mentioned all the relevant case laws also. 164(2)(3) and 167B. So this brings me to the end of today's syllabus, which was allotted to me. So I'm open for queries. Now, thank you. I think I have completed in time.
If anybody want to ask any question, please, you can ask. There are 4 to 5 questions on Zoom meeting. Whether donation given towards building fund will be considered as corpus donation?
Yes. See, for a donation to be treated as corpus donation, first and foremost, there has to be a direction from the donor. The donor has to direct that this fund should form part of the corpus fund, and he may further specify that this fund should be used for so and so purpose, for example, building purpose or whatever, as the case may be. So, but there has to be a specific direction, and mind well, there is no format as such. The direction letter can be very simple, that I'm giving so and so donation, and this donation should form part of the corpus donation, and it may be used for so and so purpose also. So yes, of course, but there has to be a direction.
Second question is, for assessment year 21-22, the CC has processed ITR without allowing credit for TDS, although the same is appearing 26 AS. Have you faced any such issue? Any suggestions?
You mean to say TDS of the TDS deducted by the deductors in the case, but charitable trust, TDS deducted of charitable trust. Of course, if it is appearing in 26 AS, we have to again reprocess the case.
Last question we can take. For assessment year 21-22, Form 10B and ITR 7 was filed on 17 July 2022 due to non-availability of audit form on income tax portal. Now CPC has issued notice for adjustment by disallowing the entire expenses claimed, saying that audit report was not filed 1 month before filing income tax return. Please guide.
See, audit, this is a challenge, as I covered, that the audit has to be filed within the time limits mentioned as per the recent amendments. Even if it is not done, you have a remedy under section 1192B. You may request the PCIT to condone the delay in filing audit reports, and your delay, if you have merits in your case, your delay will be condoned and you will get the due deductions.
Sir, there are many more questions, but we are running short of time.
Yes.
So we can, we will answer, give it the answer, and we will email them for rest of the questions. So, yeah. Yeah.
Sir, can I? Sir, in the section which you mentioned, 164.3 and 164.2, we have received some intimations from CPC where they have not allowed deduction. The trust was not registered under 12A. We have actually replied to them by rectification, but then even in rectification order, they did not allow the expenditure.
In that case, I would request, I have faced such a situation. In that case, I will request that you go to the concerned ITO exemption and you tell him, sir, please call this particular case to your table, because CPC will, assess it manually as per the parameters set by them. So you should call your return back to the concerned assessing officer, jurisdictional assessing officer, which you may call it, and you present your case before him. And when you are writing to the income tax department, you have to submit your registration certificate, whereby it shows that your trust is a public charitable trust, and make a mention of 164.23 and 167B. Definitely the return will be rectified in your favor.
Oh, thank you.
Definitely.
Thank you. Thank you, Ravi ji. It's my great honor. One question. Sir, one question.
I think I am as an exception being allowed to ask two questions.
Yeah.
And number one is that if the depreciation has been allowed to be carried forward for earlier years after the amendment from 21-22, what will happen to that? That will lapse at that point, or that will be allowed to be further carried forward? At least at those depreciation, those carry forward losses which have been allowed in the income tax system.
See, earlier when the act was allowing the depreciation, you have claimed it very rightly. But now,
deficit. No, I'm sorry. It is deficit. Deficit which has been accepted and allowed up to a particular assessment year, whether that will be allowed to be carried forward after 22-23 also.
no, deficit now after the amendment, deficit will definitely not be allowed. Otherwise also, earlier the situation was, there is no provision in the income tax return to adjust the deficit against the surplus. So it was always a disputable matter. And now there is no question that your deficit will be adjusted against the surplus of the subsequent previous year.
And one more question.
Yes, sir.
That section 11.2 and 11.3 requires the accumulation for the purpose of objects of the trust.
Right.
It doesn't require for the purpose of a particular project of the trust. Right. Now, objects are as specified in the trust deed or maybe in the memorandum of association. Now, suppose, and many assessing officers are allowed that this will be carried forward for the objects of the trust. Now, if the objects can be any object which are of the revenue nature, also capital nature also.
Right.
Whether that we can claim as a
See, the objects have to be specific. The objects may be more than one. That is not a problem. But you cannot list down the entire objects as mentioned in your constitutional document. Suppose if you have mentioned 10 objects in your constitutional document, you may pick and choose, like, you may write 3 or 4 objects, but it is not so that you'll be allowed to spend that money on all the objects of the trust. You have to pass a resolution. You have to be specific that this money has to be used for 1, 2, 3, 4
but
objects.
In form number 10, we are only saying that the objects of the trust. That's all. And
that is correct, sir. That is very true. But the objects have to be specific.
Okay.
Thank you. Thank you, Ravi ji. It's my pleasure to give a hearty vote of thanks to CA Ravi sir. Sir, without saying, this is the love and your dedication to the subject matter, that without asking they are giving round of applause to you. So nothing to be say more. And thank you a lot once again to accept our invitation in a such short notice, and given deliver a so nice lucid presentation with practical examples. Sir is here for in the break also. We have to start our last session of the DTRC. With Sir CCM Sir Purushottam Khandelwal is here. Sir, please come to the desk. So he because we are running short late, he has to catch a flight. Sir, may I, Purushottam sir, may I request you to share a few words with us?
Good evening. I will not take much of our time because you all are in the busy session of the learnings. I know. Respected Chairman of the WRC, Murtuza Kanchwala, Secretary Sweta Madam, Regional Council Member Pinky Kedia ji, Faculty Ravi Gupta ji, and respected members. It gives immense pleasure to be amongst you. And I congratulate and compliment to WRC for organizing such a wonderful DTRC series at the Mumbai. And this trend continued from so many years. I got also an opportunity to serve as a secretary of the WRC in year 2018-19. But few things I would like to share, that after the change of Chartered Accountant Act, members should take utmost care before signing a financial statement. A tax and audit, we are in our core subject. So all the members are mainly interested in the tax conferences. And wherever we are organizing an audit conference, nobody is remain present. And it's government and the regulator expect much more than what we give true and fair view. They want true and a correct view. So the episode of the North India, where the CA has been arrested, we detailed prepare a SOP and given to the Home Ministry and the all state home ministry also, to follow a special operating procedure before arresting a CA. Our intention of council to provide a tension-free atmosphere and work environment to the members so they can freely work. I could not advocacy of the any culprit chartered accountant, but those who are fairly working should not be work in the tension. So my humble request you to please be careful for signing a financial statement. We have did lot of inputs and initiative at the Delhi also. Currently, I am a vice chairman of committee for member in practice, which is the core, and most of the members are in the practice. And we try our best to improve the quality of the chartered accountants. And how to improve, we are just floated a 2 tender for the providing audit tools to the member free of cost. One is to audit analytical tools, and other is the practice manual software. The board, the software will make you available to the free of cost. Apart from that, we have launched a number of initiatives and tie up with the insurance company to provide benefits member to the free of cost and at a lower rate or much more savings for the you. Again, I have hanging career counseling. So a career counseling institute, you will happy to know that what the institute is working for the new students to join the chartered accountant course. We have given a 75% discount in the Northeast students. Just I did one program at Jammu Kashmir, and my intention was to apprise the student that the CA course is the best for future and you can afford this course. Our course is very, very affordable course. I'm not saying the cheap course because it's very hard. It's not easy course, but it's not charging more much than. And even though out of that, we are also given 75% discount to the Jammu Kashmir student and Northeast students. So institute is taking so much care. You are coming and I had given session chairman of the dividend taxations. So the government has already removed the dividend distribution tax and now the dividend is in the, taxable in the hand of the respected payee. So the corporate will having a liquid funds to do for something else. And apart from that, the government of India and institute is working for the sustainability board. Now we are thinking much more other than the audit. So what about the planet, people's, अगर planet ही नहीं रहा, people नहीं रहे, तो हम audit करके क्या करेंगे? So वो carbon extension के बारे में काम करें, standard तैयार करें, सभी के साथ मिलके हम social standard ले आ रहे हैं. So we are do lot of works for the members and students. Now, apart from that, if you have any suggestion, so all the council from West India, 11 council member and the chairman and the regional council member is ready to hear you. Are we waiting for your any suggestion? Thank you. Thank you so much for giving me an opportunity and had me. Thank you so much.
Thank you so much, Purushottam sir, for your word of wisdom. So friends, we will stay here for a very short break, but my request is please come as soon as you can, because our next speaker is already here with us. Thank you so much. Member. So without taking much time, I request to our colleague Pinky Kedia to please introduce our speaker.
Thank you, Sweta, to give me a pleasant task to introduce our today's DT. In fact, last speaker of the DTRC, but not the least. Anish Thacker is a fellow member of Institute of Chartered Accountant and law graduate from Mumbai University. He has more than 3 decades of experience in income tax advisory, compliance, and litigation assignments. He is working as a partner in SRBC and Associates LLP and looks after tax litigation and advisory. He has worked with BSR and Company and also practiced in his firm name AM Thacker and Company. He was the president of the Chamber of Tax Consultant for the year 2020-21. He is the member of the core group of Bombay Chartered Accountant Society and the Chamber of Tax Consultant. He has written articles in various newspapers, business magazines, and professional journals and online portals. He has contributed papers and spoken at seminar and conference for professional forum and as well as industrial forum. He has appeared on television as a guest speaker for business channel like CNBC TV 18, Bloomberg, NDTV, ET Now, CNBC Awaz, etc. With this brief introduction, I request all to welcome him with good round of applause, please.
And I would like to request our chairman to please present a bouquet as a token of appreciation.
Hello, am I audible? Yes, I believe so. I think without it, I am also audible. Thank you very much. Just seek the blessings of the Guru, my Guru Magan Bhai, and all my other Gurus before starting. Dhyan Moolam Gurur Murti, Puja Moolam Gurur Padam, Mantra Moolam Gurur Vakyam, Moksha Moolam Gurur Kripa, Om Shri Gurue Namaha. Invoking the blessings of the Gurus, let me first thank the Institute of Chartered Accountants of India, the Western India Regional Council, my dear friend Murtuza, Shweta ji, Pinky ji, all the other office bearers, Pushottam ji, in absentia. I know he had a flight to catch, but very nice of him to at least acknowledge that I was, going to speak. So thank you very much, all of you. And of course, to all of you for who are going to bear with me for the next hour and a half. And I promise that we will try and finish within the hour and a half. I will start with two disclaimers. One, as usual, views are personal. Two, there is no criticism intended to any government official, anybody, in terms of certain observations that are being made. Because I think today intolerance is, unfortunately getting higher and higher day by day. And therefore, I want to make it very clear that when I give examples or when I say something, I'm not in the mood to criticize. I'm only saying what I genuinely feel from the heart. So if we go to how dividend taxation has panned out throughout the years, just one second, I'm not able to move the slides. Can you help me, please? I'm not able to move the slides. हाँ, राइट क्लिक करेंगे तो होगा. हाँ, ये हो गया, but मैं राइट क्लिक किया तो हाँ हो रहा है ना, ठीक है. All right. Thank you, Mishra ji, and sorry again for the interruption. This is the overview of what we are going to deal with today. And you may wonder as to why this overview is presented in the manner it is presented, where something is to the left and something is to the right. And this is only because the taxation of dividends has actually moved left, right, ever since it has been introduced. So if we look at it very clearly, and you'll have to permit me to read something from this very closely because I have very high myopia, as you all know. But I will look at this and read some things from here. Now, as we know, up to 1997, dividend was taxed in the hands of the shareholder. Everything was fine, no problem. There was a 2,500 basic exemption limit, after which there was a TDS. And I believe that apart from the record keeping of the dividend and the TDS, there was no challenge with the system of taxation at all up to that date. But we were confronted with the dream budget of 1997, where at that point in time, the thinking of the government was that let us try and minimize record keeping. Let us try and minimize the impact on the smaller taxpayers, and therefore let us try and collect tax at the source itself. And therefore they changed the system of taxation of dividend to a DDT based system where the company distributing the dividend had to pay DDT and the shareholder was eligible to claim an exemption for the dividend in his return. Right? Now, that was, as I mentioned, introduced with an objective to ease compliance, to minimize record keeping, right? And in the explanatory memorandum, it actually says that it is meant to reduce paperwork for the company in terms of keeping the TDS, etc., and also for the shareholders, because shareholders used to receive very small amounts of dividend, and for them to take note of that and add all those dividend income into their returns was a little bit of a challenge. Some shareholders actually did not probably show dividend income at all in their returns. People just filed their returns showing salary income and bank interest, and that's the end of that. And therefore, the DDT system was introduced. Now the DDT started at a 10% DDT, right? Continued that way for 5 years till 2002, where for 1 year, we again went back to the classical system of dividend taxation. And then from 2003 again, or from 1/4/2004 again, or assessment year 3/4, I think, yeah, it's assessment year 3/4. For the assessment year 2/3, the dividend was taxed in the hands of the shareholders. In 3/4 again, we went back to the DDT. DDT got increased to 12.5 and then kept on going up. Today, whatever, before its abolition, the effective DDT rate was 20.47%. Point is that somewhere, why is this happening? This is happening because I think the government is listening to every stakeholder that it is, confronted with. Earlier, it said that the burden was too much for the smaller shareholders. Now, when it goes back to the classical system, the reason is that foreign institutional investors or foreign investors are not able to claim credit in their home country, and therefore there's a problem. So if you listen to everybody, then you end up like the father, the son, and the donkey story, right? And which is what unfortunately has happened to dividend taxation over the years. So we'll not go into what has happened, but I would believe that again, it's a problem. These are really the rates at which dividend is now taxable. We will not bother ourselves too much, except to recognize and understand that the surcharge on dividend is capped at 15%. And therefore, for individuals, the maximum rate of taxation of dividend is 35.88%, right? For all the other categories of taxpayers, the rates are mentioned here. The presentation is there before you. You will get the slides, and therefore we will not spend too much time on this. Now let us go to what dividend is. And this may be a little bit of a refresh for all of us, but this is indeed a refresher course. So therefore, let us try and go back and understand what dividend is all about. If we look at section 222, then dividend is not precisely defined. Dividend is defined in section 222 in an inclusive manner. And the inclusive manner has 5 different inclusions of artificial receipts by a shareholder, which would otherwise probably not be regarded as dividend. And in some cases, probably also not be regarded as income. But what is therefore dividend? Dividend is something that is received by a shareholder from a company, right? In terms of distribution of profits of that company. Those profits can be capital profits. Those profits can be revenue profits. But it is distribution of profits that a shareholder receives. Okay. Now, from that perspective, one would always believe that if there is no shareholder and there is no company, there can be no dividend. So look at a company limited by guarantee, for example. Any distribution that comes to a guarantor from that company will never be dividend. It may be income, but it will never be dividend. Same way, there are many foreign companies who are otherwise not falling into the definition of a company or any other foreign entity. Take, for example, a foreign limited liability partnership. It may be a separate person as far as jurisdiction, its own jurisdiction is concerned. It may be a separate entity as far as that particular jurisdiction is concerned. It may not be incorporated under the law, and it may only be formed under the law of that particular country. And if it is not incorporated, we know that it can never be a company. So again, we will have to look at each and every scenario, particularly today, because we are having scenarios where people now are investing overseas. And if they are investing overseas, they will receive distributions from various sorts of entities. And once you receive distributions from these entities, you will have to, in each situation, look at whether it is dividend or not. Why is that critical? It is critical because there's a deeming fiction that dividend is always taxable as income from other sources. Now, even if you receive dividend in the course of your business, by virtue of the artificial categorization of dividend under Section 56, a dividend will always be taxed as income from other sources. Of course, we have case law prior to the amendment. And even today, there's a school of thought to say that if dividend is received in course of business, it will be business income. I would not ascribe to that view. I would ascribe to the view that dividend is always income from other sources because Section 56 very clearly mentions it. And therefore, one will have to, again, as far as deductions are concerned, test it on the strength of Section 57 only, and not on the strength of any other section like Section 37, etc. However, if a receipt from any foreign entity does not qualify as dividend, and you are able to establish a nexus with your business, then you may still be able to claim expenditure against that particular income. This is why the characterization of something as dividend or not is important. Now, again, 222 extends the scope of dividend, right? Once we understand that 222 extends the scope of dividend, it's very clear that what is otherwise not dividend becomes dividend by virtue of Section 222. And we have 5 subsections which deal with 222. First is subsection A, which is a distribution by a company of accumulated profit, whether capitalized or not, if such distribution entails the release by the company to its shareholders of all or any parts of the assets of the company. So there has to be a distribution. A distribution means there has to be more than one shareholder, right? Punjab Distilling, 57 ITR 1, Supreme Court, we all know. It has to be distribution. It has to be accumulated profit. We'll come to accumulated profit in just a little bit. But it has to be distribution of accumulated profit to a shareholder by a company, which entails the release of the assets of the company. So very wide definition, but we all know what it means. So therefore, we'll not get into this. 222B, any distribution to the shareholders of a company by of debentures or debenture stocks or deposit certificates in any form, whether with or without interest, and any distribution to preference shareholders of shares by way of bonus to the extent of which company possesses accumulated profits, whether capitalized or not. So again, a bonus to an equity shareholder is not regarded as deemed dividend. It was only regarded as deemed dividend for 1 year, 64 to 65, before I was born. And before I think most of us were born, maybe probably Sharmaji was born then, he would have known. And his thirst for learning and his enthusiasm to learn is frankly amazing. And I would always consider him to my mentor and role model as far as the urge to learn is concerned. At his age, it's fantastic. And I can tell you that before he came here, he was in an IFA session listening to Mr. Kamlesh Varshney talking about 194R and 194S. So hats off to you, sir. C, any distribution made to the shareholder of a company on its liquidation to the extent of which the distribution is attributable to the accumulated profits of the company immediately before the liquidation, without whether capitalized or not. Only one point, amounts up to the date of liquidation also should be considered in accumulated profits, provided the accounts are drawn up. We are all aware that ED Sassoon tells us, 26 ITR 27 Supreme Court, that profits accrue at the end of the accounting period, but now listed companies maintain accounts on a quarterly basis. Accounts are drawn up, balance sheets are drawn up on a quarterly basis. 222D, any distribution to its shareholder of by a company on the reduction of its capital to the extent to which the company possesses accumulated profits, which arose after the end of the previous year, ending next before the first day of April 1933, whether such accumulated profits were capitalized or not, right? And I just at this stage want to draw your attention to a recent decision of the Bombay Tribunal, which came yesterday in the case of JP Morgan, where the assessee received bonus debentures, as we call them, right? Where bonus debentures were received by the assessee. The company paid DDT on the bonus debentures. The assessee claimed that the amount of dividend on which the DDT was paid is the cost of acquisition of my debentures when it sold them. The assessing officer and the DRP said nothing doing. This is not cost of acquisition and you have not paid anything for this, right? And therefore we will give you cost of acquisition is 0. But going into the facts, going into the scheme and noting the fact that there was a payment of DDT by the company and the amount was kept in escrow with a third-party merchant banker who then appropriated the money towards the subscription of the debentures. The tribunal in JP Morgan's case yesterday has held that it is, the dividend that it is on which the DDT is paid is the cost of acquisition for the debenture holder. The next subsection is our favorite subsection of section 222E, that any payment by a company in which the public are substantially interested or not substantially interested of any sum, whether representing a part of the assets of the company or otherwise, made after the 31st day of May 87 by way of advance or a loan to a shareholder, who is the beneficial owner of shares, not being shares entitled to a fixed rate of dividend, whether or not without a right to participate in profits, holding not less than 10% of the voting power, or to any concern in which such shareholder is a partner or a member, or in which he has substantial interest. So this is again a section which has invoked a lot of litigation. There has to be a loan, there has to be an advance, and the loan and the advance is taxable. We will come to some of it, what is loan, what is advance, what is not loan or advance a little later. Now, as I was saying, 2 or 3 things that we, remember, right? And if you receive dividend in kind, then the market value of what you receive is the dividend, right? There is a case of Central India Industries 82 ITR 555 Supreme Court where distribution was of shares of another company and the market value of those shares was held to be dividend in the hands of the shareholder. As far as return of capital is concerned, it is not dividend, only and only to the extent of accumulated profit. Dividend is taxable, right? And there's a decision of Urmila Ramesh, 96 Taxman 553, which basically was a case where it was a balancing charge which was sought to be taxed in the hands of the shareholder as dividend, which the Supreme Court said nothing doing. But look at some of these things, where you think that these are simple things, you understand them normally, but these have gone all the way up to Supreme Court. So it's a big challenge. Anyway, coming back to what is accumulated profit. Now, for different sections, the accumulated profit definition is actually different. It includes all the profits of the company up to the date of distribution of payment. For subclass C of 222, it includes all the profits of the company up to the date of liquidation, but does not include any profits of the company prior to 3 successive previous years, immediately preceding the year in which such acquisition took place, whether liquidation is consequent to compulsory acquisition by the government or by a government corporation under any law. And for amalgamated companies, accumulated profits or loss, as the case may be, is increased by the accumulated profits of the amalgamating company on the date of amalgamation. Now, accumulated profit obviously means profits in the commercial sense. Ravi ji just dealt with what is profits in the commercial sense, so we will not look at it. But they mean profits as a normal person understands it, not artificially computed as far as income tax is concerned. So they are commercial profits. Again, the character of distribution does not necessarily have to mirror the character of the receipt. So we are all aware of the famous case of Bacha Gazdar 27 ITR 1, where dividend was distributed out of agricultural income. The assessee sought to contend that the dividend was agricultural income and therefore exempt in nature, but the Supreme Court negated that contention. We've said it includes profits up to the date of distribution. Raman Lal 98 ITR 349, right? accumulated profits do not include amounts that have already been assessed in some earlier year as deemed dividend. So that also something we have to be careful, that if something is already assessed in an earlier year as deemed dividend, then that cannot be doubly added to accumulated profit when you're looking at a subsequent year. G. Narasimhan, 2006 ITR 327. Now, coming to the next aspect of the taxation of dividend, there are certain exceptions in 222 itself, which dividend does not include. And what does it not include? It does not include distribution made in accordance with subclauses C and D in respect of any shares issued for full cash consideration where the shareholder is not entitled in the liquidation event to participate in the profit. So if there are shares which are issued which do not entitle the shareholder to participate in the residual property of the company on liquidation, such amount on any of those shares will not be included in accumulated profit. Distribution made in accordance with clause C or clause D, insofar as the distribution is attributable to the capitalized profits of the company, representing bonus shares allotted from 64 to 65. We said that in those years, bonus shares actually were taxable as deemed dividend. So therefore, they are excluded. Any advance or loan made to a shareholder or the concern that we talked about for 222E by a company in the ordinary course of the business, where the lending of the money is a substantial part of the business of the company. Now, so obviously it has to be an advance or a loan, and we'll come to what an advance or a loan is. But the business of money lending has to be a substantial part of the business of a company. And the question has, arose time and again in terms of what is substantial. And therefore, do you look at the income that you earn from that activity? Do you look at the capital that you employ in that activity? Does substantial mean that it has to be more than 50% in terms of income and in terms of capital? We're aware that, under NBFC guidelines, we have a 50% income, 50% criteria, asset criteria for a company to be qualify as NBFC, right? And there also the word used in 45, IA of the RBI Act is substantial. And therefore, can you take some color from that? No, says the Bombay High Court. Bombay High Court in Parle Plastics says that substantial does not necessarily mean the majority of the business, that is more than 50%. What you have to look at in terms of criteria are, absolutely, different criteria. So therefore, you will have to look at how much effort you put into that activity, for example. How much is the capital that you employ in that activity? How much is the return that that capital generates? And it has to be a significant part of the business. It is not that it has to be more than 50%. It could be 30%, but it has to be a substantial part. It should not be a very small or minuscule part of the business. And if your substantial part of the business is that of lending money, then obviously 222E does not apply to you because you are covered by the exception. Now, any dividend which is paid by a company, which is set off by the company against any whole or any part of such sum previously paid, treated as dividend 222E. Logical, because you can't tax the same amount twice. Any payment pursuant to buyback of shares under a scheme approved under the Companies Act, and because there's a specific section which deals with buyback, as we all know, and any distribution of shares pursuant to a demerger by the resulting company to the shareholders of the demerged company, whether or not there's a reduction of capital in the demerged company. So these are the exceptions that 222 itself carves out on what is not included as deemed dividend. Now, let us look at what does distribution versus payment mean. And Section 8 taxes dividend as and when it is either declared, distributed, or paid. We'll look at declaration slightly later. Let us look at what distribution versus payment is. Now, as far as distribution versus payment is concerned, clauses A to D of 222 use the word distribution, right? And clause E uses the word payment. So is there a distinction between the word distribution and a distinction between the word payment? And I believe there is a distinction between the two. Distribution has two activities. The first activity is a division. So whatever is a pool, I divide that pool into more than one. And once I do that, that is what I connote by distribution, right? So if somebody has an apple and he cuts it into two and gives it to two different people, that is a distribution. But if he picks up that apple and gives it to one person, then there is no distribution. And that principle is accepted by the Supreme Court in Punjab Distilling's case, 57 ITR 1. And the second part is obviously a delivery. So firstly, I have to divide something. Secondly, I have to deliver it to more than one person. Then it is a distribution. Whereas payment is something that is given and it need not have been first apportioned or divided and then given. So payment can be a one-on-one payment. So for A to D, you need necessarily more than one person. But for 222E, it can be one person or not. So if there's a single shareholder or a single concern, then obviously 222E will get tracked. The two expressions obviously have different meanings and therefore are not synonymous. A distribution may result eventually in a payment. It has to, because if there's a cash distribution, then it will. If there's a distribution in kind, it will not. But it may result in a payment. Whereas a payment will never be as a result of a distribution, not always. Now, distribution is a division among several persons, whereas we saw that the recipient may be a single person. Now, does a shareholder need to be a registered shareholder, or does he need to be a beneficial shareholder for taxation of dividend in his hands? Again, I think, controversies have been galore in all of these cases. If you look at Ramesh Marlal, Savarmal, 122 ITR 1 and Bhaumik Color, it seems to be that the person has to be the registered holder of the shares. Okay. But in Madura Courts Private Limited, 274 ITR 609, the AR held that in absence of any direct shareholding by the shareholder giving loan in the share capital of the borrower, the loan could not be treated as deemed dividend. So what is the beneficial owner of a share? So he has to be a shareholder, has to be two things. One, he has to be the registered holder. Two, he has to be the beneficial owner also. Now, what is beneficial owner? Beneficial owner is somebody who is entitled to the financial benefits arising from the assets of the company, with whom the real rights in the shares which are transferred, this will not cover cases where the owners of the real rights or powers attached to the shares remain the same, and is a person who is different from somebody who holds controlling interest. And ultimately an ultimate holding company, say there's company A held by company B, held by company C. Company C being the ultimate holding company, they have controlling interest, but will not be the beneficial owner. Beneficial owner will be company B for the purposes of 222. And of course, loan granted to a beneficial owner who is not a registered shareholder should not fall within the purview of section 222E. Now, this whole controversy of beneficial owner or not is actually before the Supreme Court in National Travel, which has been referred to a larger bench. The citation is 401 ITR 154, but the matter is still not free from doubt. Now, if we see one decision in case of partnership firms or HUFs, because that will be again important. So as far as partnership firms is concerned, can a partnership firm be treated as a shareholder, even though it is not a registered shareholder? We saw that for dividend, it has to be a registered shareholder and it has to be a beneficial shareholder also. So as far as National Travel was concerned, Delhi High Court, which was now referred to Supreme Court and is now before the larger bench, and in Bharti Overseas, there the High Courts have taken a view that a firm cannot be treated as a shareholder only because the shares are held in the names of its partners is not acceptable, and therefore nothing doing the firm is a shareholder. Similarly, there is a decision for HUF also, where the shares are held in the name of the Karta, Gopal and Sons HUF 391 ITR 1, where the Supreme Court again has taken the view that shares held in the name of the Karta do not not make the HUF a beneficial owner. But there is a very recent decision of the Ahmedabad Tribunal, which was delivered as late as February 22. I don't remember the name of the this thing, where again the concept is they've taken note of Gopal and Sons, and they have distinguished it, saying that you need to be a registered shareholder. So this controversy is still there, right? And therefore, one will have to wait till the larger bench decides in terms of what you need as far as this thing is concerned. Now, obviously, there is also a circular number 495 and dated 22nd September 87, explaining that dividend is taxable in the hands of the borrower when certain conditions are satisfied. Now, what is a loan or what is an advance? A loan presupposes something that has to be repayable, and the person who accepts the loan also accepts the obligation to repay. So if there is something which comes with an obligation to repay, there is a loan. Otherwise, there is no loan. So if, say, somebody pays me advance fees, right, then that's not a loan, because I'm going to do work and give it to him. I have no obligation to repay that amount back to him. My obligation is only as far as the work to be done is concerned. It is not for the repayment of the loan. And there is a decision of Creative Dyeing, Delhi High Court, 184 Taxman 483, which again accepts this principle that if there is something to be done in terms of service, then there is no loan as far as the recipient is concerned, right? Again, obligation of repayment, Rajkumar, we have already seen. Loan means lending, delivery by one party and receipt by another party of a sum of money upon agreement express or implied to repay it with or without interest. Every loan is a debt, but every debt is not a loan. We understand that. If we look at set theory, debt is a whole set and loan is a subset. There are other debts which could be not loans. What is an advance? An advance is a wider term than a loan. An advance can be for something to be returned. It can be for some work to be done. It can be for some other thing. It is just some money given in advance. For the purpose of 222E, advance has to be read in conjunction with the loan. So therefore, the thought is that a loan or an advance somewhere goes synonymous or hand in hand, and the advance should be in the nature of something which is repayable. That again is debatable, but certainly there are certain cases of advance which are covered, especially under the exception, which there is a circular number 19 of 2017, dated 12th June 2017, where certain cases of advance are not treated as loan, and they have referred to certain decided cases in that circular. Now, of course, it is also important that as far as the recipient is concerned, the treatment as dividend does not alter the character. So somebody cannot say that I have taken a loan, right? I am now no longer obligated to repay because it is dividend in my hands. I have paid income tax on it. That is not acceptable. Business or commercial transactions, payment for purchases or service utilized or paying on account of any other ground where such payments are made in the ordinary course of business. Is it loan or advance? I would believe no. Business transactions with related concerns are not covered in its securities, Mumbai Tribunal. Also, current account is not a loan and advance. It is Malayala Malonrama 405 ITR 595 and Deepak Veg Pro 406 ITR 496. If you have current account with your associated company, that is not regarded as a loan or advance for the purposes of 222E. Trade advance, is it covered? No, Rajkumar. Is advance towards purchase or job work covered? No. These are the citations again. Nagin Das Kapadia, Rajkumar, and Ambassador Travels. Advance for monetization of plant and machinery, which was to be adjusted against future dues or bills in ancillary units. Is it, loan or an advance? No, as we saw creative dying, 184 taxman, 483 Delhi. Is loan taxable even if it carries a commercial rate of interest? Yes, it is taxable as deemed dividend, even though it carries a commercial rate of interest. Now, any other scenario? Is payment in kind covered? I would believe yes, it is covered. Payment which represents, part of the asset buy of an advance or a loan is definitely covered. MD Jindal. Loan repaid before the end of the previous year, is the loan given during the year tax? Yes, unless it is set off against the earlier years. So at each loan rest, you will have to see what is the accumulated profit. Tarulata Sham, 108 ITR, 345. Should loan taken prior to becoming a shareholder also considered? The answer is no. Sagar Sahil Investment. Whether share application can be treated as loan? No. But in certain cases, you have to look at substance over form. Take this latest case, the last case that I have mentioned, Sunil Chopra, where what had happened was that in the balance sheet of the company, there was an advance given to the shareholder for 5 years for purchase of a property. For 5 years, the property was not purchased at all. And there the court has held that nothing doing. This is a sham transaction. You are coloring a loan or an advance as a business transaction for purchase of property. What stopped you from buying the property for 5 years? You were not able to give a convincing answer. And therefore, this is nothing but a loan or an advance, and therefore accessible in the hands of the person under 222E. So one will have to be careful that it is not that, the moment you show something as a trade advance, it will automatically not get covered as loan. One will have to justify why the advance is continuing year on year in the balance sheet. A security deposit for leasing of premises certainly is possible, but the premises have to be leased out for that year. If there is no leasing out of the premises, then obviously there will be a challenge in terms of demonstrating the substance over the form. Intercompany deposits, we will not get into this again too much. The reason is that I believe that intercompany deposits are not loans and or advances. This has been now beaten to death. But in any case, India is a very litigation prone country. We're very happy to litigate. Sometimes we're happy to litigate because the opposite party doesn't see reason. But unfortunate part is that yes, litigation continues even on something like intercorporate deposits. But I would believe that again, it is not a loan or an advance. If a company obtains a loan from an unrelated company in which the assessee has substantial interest, and thereafter that other company provides loan to the shareholder, then is deemed dividend applicable? The answer is yes, if there is an interconnected transaction. And again, the principle of substance over form will have to see that you are not going to escape from the clutches of 222E if you're going to just break the transactions, right? And, we are very adept at doing some things like this. But please remember that if there is an interconnection which is demonstrated, then we may have trouble as far as is 222 is concerned, as was the case in Nandlal Kanoria, where a linkage was very clearly established. Now, whether a loan obtained by an employee of the company as per the instruction of the managing director, who is also a shareholder, and in turn passes on to the loan to the same managing director, attracts deemed dividend? Yes, because managing director is also a shareholder. If the managing director was not a shareholder, God knows what would have happened. But in this case, unfortunately, the managing director was a shareholder, and therefore, in Alangasundaram Chettiar's case, the Chennai High Court held that this is a dividend. Now, as far as taxability and hands of HUF, we saw Gopal and Sons case that if the Karta is the registered shareholder, then the Supreme Court has held that deeming provisions are to be strictly interpreted, and unless all the conditions therein are satisfied, the receipt cannot be termed as dividend. Further, in case of two use, benefit shall be given in the value of the taxpayer. Even if it is presumed that Karta is not a registered shareholder as per the provisions of 222E, read with explanation 3 there too. Once the payment is received by the HUF and the shareholder, i.e. Karta, is the member of the HUF and has a substantial interest in the HUF, then the payment made to the HUF shall be deemed dividend as far as 222E is concerned. The decision that I was talking to you on Ahmedabad is called Amit Intertrade Private Limited, 137 Taxman 488, where it said that nothing doing, you have to be a shareholder. But the whole system of taxation, whether it is taxable in the hands of the shareholder or the concern, all of that is still there. And, there are two views possible. One view is obviously that it has to be only taxed in the hands of the shareholder. The other view is that it has to be taxed in the hands of the concern. And therefore, sorry. Just a minute. Sorry, I'm just a little lost because my hard copy and this is a little different. Okay, all right. We go to accumulated profit. And what is accumulated profit? Now, accumulated profit we did discuss in a little bit, but some adjustments has to be made here. And, one has to recognize that profits, do they accrue evenly throughout the year or not? And a fiction, obviously, that they accrue evenly throughout the year has to be carried to a logical conclusion. And therefore, it is fair to assume that profit accrue on a day-to-day basis, yearly profit to be apportioned till the date of the event, as we saw. Right? Now, of course, if you are able to demonstrate that the profit does not arise evenly, right? As, for example, in ED Sassoon, where the profit accrued only at the end of the year by virtue of the managing agency agreement that has been executed, then obviously you are entitled to exclude the proportionate profit. Adjustments to be made. Business profits do not accrue from day to day or month to month. And therefore, current year's profits, which are not included, somewhere you can make adjustments. And therefore, the question is, if say the shareholding is 30%, can deemed dividend be restricted to 30%? The answer is no. The entire amount is taxed as deemed dividend. Loan repaid cannot be credited to accumulated profit. We've seen this national travel services in some manner, but it is basically the whole issue of whether it is taxable in the hands of the shareholder or hands of the concern. Matter is pending before a larger bench of the Supreme Court. We will not get into it, but I would think that unless I would believe that the taxability of 222E has to happen in the hands of the shareholder, it cannot happen in the hands of the concern, which actually is the recipient of the money. Some arguments do exist that it has to be in the hands of the concern, but I would believe that the concern, in a way, the law assumes the concern to be, into inverted commas, a front for the shareholder. And I'm not using front as a proper legal term. It's just for us to understand that this is something that the shareholder has received as by way of something that is given to the concern, and therefore the taxability should happen only in the hands of the shareholder. Now, so we saw this Gopal and Sons already, and the view that, view 1 and view 2. So we'll not get into this. Now let us go very quickly in terms of whether under tax treaties, dividend can be taxed as, deemed dividend can be taxed as dividend. And let's take the example of the India-US treaty here. Now in India-US treaty, I'll just go to paragraph 3. The term dividend as used in this act means income from shares or other rights, not being debt claims, participating in profits, income from other corporate rights which are subject to the same taxation treatment as income from shares, by the taxation of the state of which the company making a distribution is resident, and income from arrangements including debt obligations carrying the right to participate in profit. So therefore, if these are the conditions, then deemed dividend can also be taxed in the hands of the non-resident shareholder as dividend. But let us see whether these characteristics actually get satisfied, at least as far as the US is concerned. Now, let us look at Whether it is income from shares, no, it is an income from a loan or an advance, and therefore it is not income from shares, etc. It arises from the grant. It is not even a distribution based on ratio of the shareholding. So therefore, there is no question of this being a dividend on that count. Is it income from other rights as we saw? No, it is not income from other rights, because it has to be a right which is like a right of a shareholder, which is say any other securities, etc. Or for example, founders shares or different class of shares or share warrants for that example, but nothing like this, right? Whether it is income from any other corporate rights, no, it is not an income from a corporate right. It's a personal right. It's a personal contract between the company and the shareholder, the borrower, right? Even if it is a corporate right, arguably, it is not subjected to the same treatment as dividend in the hands of the shareholder. So therefore, no DDT, at least in the good old days, right? Then the law was amended, but in the first instance when DDT was introduced, there was no DDT on 222E. Payment was not distribution, and therefore it is a payment to some cases non-shareholder, a concern in which a shareholder had a substantial interest. So therefore, it is not a dividend. It is not an arrangement at all, right? The arrangement does not grant the shareholder the right to participate in the profits of the company. So in that context, one would believe that it is not a dividend as far as treaty is concerned, or 222E dividend. There are certain arguments in favor, which says that income is not defined in the treaty. It's an inclusive definition. 224 includes dividend, and therefore dividend would be income for the purpose of the act, and therefore for 224 dividend is what is defined in 222, and therefore that is income as far as the treaty is concerned. Since the payment of the loan is under the act, it is income under section 12, article 10(3), sorry. Since the income is because of the shareholding in the company, by virtue of the relationship with the shareholder, the lending has happened, it could be said that the loan or advance is an income from shares, and therefore dividend for the purpose of India US DTAA. And it is basically, you have to, OECD commentary says you have to refer to the domestic law of the country. And therefore it is taxable under domestic law. It should be taxable under the treaty. These are the arguments that somebody can take as far as the department is concerned. I would personally believe, and again, I have said this at the bottom, that I don't think this is dividend under the treaty at all. So 222E is certainly not dividend under a treaty. Okay. And also remember that is that a dividend which is paid? One, there are again arguments to say it is not even paid. We will not get into all of this as of now. If this is not dividend, can this be taxed as other income? And sometimes you can actually end up in a worse scenario, because other income is taxable at normal rates, whereas dividend is taxable at concessional rates. As we know, dividend is taxable between 5% and 15% under all the treaties. Some treaties tax at 20%, very, very few treaties, but otherwise 5% to 15%, generally median rate being 10%. Now, is this other income at all? My answer is again no, because the other income article of a treaty only looks at income which is not mentioned in any of the earlier articles. And dividend is an income which is mentioned in the earlier articles. In any case, one has an argument to always say that this is not dividend or this is not income at all. And therefore, it is a transaction on capital account, and therefore it should not be. However, one has to remember that in DLJMB Mauritius, the AR actually ruled that dividend from a mutual fund, which are not dividend from a company, will not fall under Article 10 of dividend. And therefore, this had to go into other income. In any case, other income in Mauritius at that time was taxable only in Mauritius, so it didn't matter. But there is some discordant note by the AR. However, this is not in the context of something like a 222E. And therefore, I believe one should not have a concern. Now, we come to the year of taxability of dividend. Now, as we know, Section 8 deals with the year of taxability of dividend. And it says that dividend will be taxed in the year in which it is declared, distributed, or paid. And what is the declaration? What is the distribution? And what is the payment? The date of declaration is the date on which the resolution is passed at the annual general meeting declaring the dividend. Okay. Distribution is when it is unconditionally made available, and paid is actually actual payment. So the earliest of these three will be the date of taxability of the dividend as far as the final dividend is concerned. As far as interim dividend is concerned, it is taxable in the year in which it is unconditionally made available to the shareholder. Now, practical challenge is this, that the AGMs sometimes are held in March of a year and the actual ex-dividend date becomes in April of the subsequent year. So you will have an AGM which is held in the last week of March, which is technically the year in which you should be actually taxing the income, but you tax it in the April of the next year because that is the date on which the exchange tells you the shares have become ex-dividend. It's a theoretical problem. I personally believe that yes, though the law says declared, distributed, or paid, the accepted market practice is to tax dividend only and only when it becomes ex-dividend, the share becomes ex-dividend, at least as far as listed shares are concerned. And this has not been raked up in any, case. And somewhere we were very worried that in the foreign institutional investors case, if the government takes it, you could have a mismatch leading to a payment of interest under 234C. But thankfully, the tax office also has remained quiet and the assessees have also remained quiet, because there is no way to know on which, in which year the AGM was held and what was the resolution passed. You'll never know by the end of the year, particularly if the AGM is held in the last week of March. We now come to deductions from dividend and section 80M, which is the important thing. That in the era of DDT, we had no problem of cascading effect. In the good old days, we had a section 80M, which basically gave us a deduction for dividends distributed out of dividends received, right? The same has now come back into this thing. Before that, we just note section 57, which says that you will not get any other deduction from dividend except to the extent of 20%, and that also will be granted only and only if you have paid interest, and no other deductions will be given to you from a dividend perspective. So very clear, we understand that very clearly. Now 80M, basically it gives a benefit only to domestic companies whose gross total income includes dividend from any other domestic company or foreign company or a business trust. So eligible assessee for 80M is a domestic company. The dividend paying company can be a domestic company, can be a foreign company, can also be a business trust, which is an AIF or a REIT InvIT. What is granted as a deduction is the amount equal to the dividend received shall be allowed as a deduction if such amount is distributed as dividend on or before the due date. And what is the due date? 1 month before the end of the date on which your return is due. Okay. So if your return is due on 31st October, your due date is 30th September of the next year. It's as simple as that. Now the question is, do you necessarily have to distribute the dividend out of the same amount that you receive? The answer is no. The section does not mandate that. You can distribute the amount later also. Can you distribute the amount earlier and claim a dividend as far as the later is concerned? So say I distribute the amount in April out of my accumulated profit. I receive dividend in, say, December of that particular previous year. Can I claim 80M? The answer is yes, I can claim 80M. Can I look at equity and preference dividend as being fungible? The answer is yes. I can distribute preference dividend to equity shareholders, and I can preference share dividend to preference shareholders out of equity dividend, and I will still get a deduction as far as distribution is concerned. Now, question is, as far as foreign dividends are concerned, up to assessment year 21-22, foreign dividends were taxed at a lower rate of 15%. It is only from assessment year 23-24 that the foreign dividends are taxed at normal rate. Now, will that foreign dividend also be eligible for ATM even though the tax rate is lower? The answer is yes. We will come to foreign tax credit in a little bit when we deal with some peculiar situations as far as ATM is concerned. But as far as conceptual distribution is concerned, availability of the deduction is concerned, I would believe it is allowable. There is no problem. Yeah, receipt again is not necessary. Timing we spoke about. All of this, is fine. I may not receive a dividend. The dividend may be declared. It may come at a later point in time. I distribute the dividend. I can claim that as a deduction. Now, two issues that we will deal with very quickly is, what is the amount of dividend that I am entitled to deduct under ATM? So take two scenarios. Scenario one, I have only dividend income of 100 rupees. I am a domestic company. I am distributing dividend to my shareholder. I have interest expense of 20, which is what is allowable to me because my dividend is 100 rupees. My gross total income is 80 rupees. I distribute 100 rupees to my shareholders. Will I get a deduction of 80 or will I get a deduction of 100? My answer is that what is included in your gross total income is only 80 rupees, and therefore you will get a deduction of 80 rupees. Let's complicate this a little more in terms of taking the example in scenario 2, where I have 200 rupees of business income. I have 100 rupees of dividend. So I have 300 rupees of gross income, deduction of interest of 20 rupees. So my gross total income is 280 rupees. Okay. And I distribute 100. Will I get 80 or will I get 100? The answer is I should get 100 if the 20 is attributable to general borrowing. But if that 20 is attributable to borrowing only for investing in the shares, then I would believe that I should be deducting 80 rupees, the 20 rupees from the 100 rupees of dividend, and then I should only be eligible to 80. So what is included in my gross total income is very important. If 100 is included in my gross total income, then I will take a deduction of 100. If 80 is included in my gross total income, then I will take a deduction of 80. Okay. Now, obviously, it is always, open to interpretation. But this is what I would believe is the correct interpretation as far as I am concerned. Now, one more issue as far as foreign tax credit is concerned. We saw that foreign dividend is taxed in the hands of the shareholder at 15% up to assessment year 22-23. And what is included in gross total income, right? It is included clearly in your gross total income. Take this example on the right. I am ICO 1. I have FCO and I have ICO 2 as subsidiaries. I receive INR 100 equivalent as dividend from FCO. I receive INR 400 from the ICO 2. So my total dividend in my income is 500. I pay dividend to 100 rupees of, or make this 200 rupees so that it will be easier. Now the question is 100 to 100 set off ho gaya. No problem. Domestic dividend 100, paid 100. 200 है तो दूसरा जो 400 में से 100 rupees है. What is the question, and can I claim foreign tax credit on the 100? Because remember, for claiming foreign tax credit, that amount has to be included in my income, and it has to be doubly taxed both in the foreign country as well as in India. So therefore, it is possible to argue that this 100 rupees out of the 200 is not taxable in the hands of the foreign company in India because it is not included in the gross total income, and therefore it is not doubly taxed, and therefore foreign tax credit should not be available. I think that is a reasonable interpretation to take, though, this will be a challenge somewhere, is because if the entire amount is not upstreamed, at least to the extent of amount not upstreamed, I believe I should be able to claim the foreign tax credit, which is In our case, 300 rupees, 400 minus 100. Now, dividend, I think we have already dealt with, which is taxable under income from other sources. Sorry. Yeah. Allowability of interest expense, we saw 20%, and it has to be interest paid. It is restricted to 20%. So specific facts again will have to be looked at in terms of the linkage of the interest paid with the dividend income. We will let it rest at this. As far as TDS is concerned, these are the rates of TDS. Very quickly, let us look at one or two small controversies. This chart we will just leave for your consumption. One controversy is the PILCOM controversy, which arises before the amendment by the Finance Act 2021, that there are specific rates provided in certain specific sections, and therefore will you actually deduct tax at those specific rates, or will you deduct tax at the rates in force as per 195? Supreme Court in PILCOM actually had said that you will deduct tax at those specific rates, and therefore there will be a challenge. So there are two cases, 196C and 196D. 196C deals with GDR dividends where there's a 10% flat rate of tax, and FPI is receiving income from securities has a 20% rate of tax. So that is a little bit of a challenge up to 2021. This controversy no longer remains, because at least as far as 196D is concerned, there is now a proviso added to 196D, which allows you to deduct tax at the rates in force. In any case, in the good old days also, when it came to FPIs, companies were happily deducting at 20%. FPIs weren't bothered because they had capital gains income against which this dividend could be offset, even if the dividend was taxed under treaties at a lower rate in their hands. So in any case, this controversy no longer survives, and therefore we will just move on to the next. Yeah. This is what we saw now. Of course, question is, sorry, yeah. All right. As far as dividend income is concerned, treaties tax the dividend at a lower rate, and some of these treaties actually tax it at a 5% rate. And there is what is called a most favored nation article, under which this clause gets attracted if you are a country with which India has entered into a treaty, right? There is another member of the OECD with which India has entered into a treaty after your treaty has been signed or notified, and that other treaty provides a lower rate of dividend withholding tax, then you are entitled to claim the lower rate of withholding tax as far as dividend distributed to your resident is concerned. So to take an example, Lithuania and Slovenia actually became members of the OECD after some of the treaties providing for 10% dividend became members of the OECD, and they have a 5% withholding tax. But they have a 5% withholding tax only and only where the shareholding is restricted to 10%. And in those scenarios, the question is as to whether you can claim benefit or not. And there are these countries, which have 10%, France, Hungary, Switzerland, Sweden, Netherlands. And if you take the MFN, all of these will get reduced to 5%. And the question is, can you claim? The answer is yes, you can claim. And there is a controversy which we will deal with in terms of, the government issuing a circular, etc., and having a different view. But before you even try and claim this, you have to remember that you have to be the beneficial owner of the dividend. And also you must satisfy the principal purpose test. So it has to be a proper structure. You can't have a postbox company in any of these countries and claim a 5% withholding tax rate, obviously. So there is Delhi High Court in case of Concentrics and Nestle, where they said that you can claim the benefit of this lower withholding tax rate of 5%. There were 2 or 3 controversies. One controversy was like this, that Lithuania and Slovenia, they became OECD members later. So the government said that, no, you have to be an OECD member right at the beginning. Your treaty can be notified later, but you have to be a member of the OECD at that time. And there should be no specified conditions to the, or no fetters to the claiming of the 5% tax rate. Then and only then we will allow the MFN clause to be applied. In case of Colombia, which became a member of the OECD in 2020, April 2020, there's no fetter on the 5%. So every shareholder which is a resident of Colombia is actually able to claim a 5% dividend. Now, of course, nobody distributes dividend to a a person who is resident in Colombia. I don't think anybody invests in India at all. They have far more lucrative businesses to take care of as far as Colombia is concerned. But the point is, Colombia became a member of the OECD later, and there was no fetter. So the question was whether you could claim all of these benefits or not. And there, the Delhi High Court in Concentrics, or Delhi Tribunal, and then the Delhi High Court in Concentrics and Nestle SA, sorry, they held that you can claim. Matter is pending before Supreme Court. In fact, the Supreme Court has listed the matter for hearing on 19th of July, exactly 10 days from now. And we will probably get to hear what the Supreme Court says in respect of this in the next few days. This is again a condition for beneficial ownership and what you need to do in terms of claiming dividend. I don't think, given the time constraints, we will deal with this. You can probably just read it. Now, coming straight to the circular, after the decisions of these Delhi High Court was delivered, the government came out, or the CBDT came out with circular number 3 of 2022, dated 3rd February 22, providing clarification regarding the MFN clause in the protocol. And it said that these are the conditions to be satisfied. 1, India's DTAA with a country which the beneficial lower rate or the restricted scope is entered into has to be, after the entry of the force of the first DTAA, which is fine. The third state has to be an OECD member at the time of its signing of treaty with India. So if you sign a treaty with a country which is not a member of the OECD at the time of signing, but becomes a member later, like Lithuania or Slovenia did, then that is not eligible. India limits its rights in taxation to the rate or scope of treaty in the third state. And India issues a separate notification under the Income Tax Act for importing the favorable rate. So unless and until there is a specific notification issued by the Indian government, the favorable rate is not allowable. So that's what the government of India says. This is under challenge in this thing. And immediately after this came out, the Pune Tribunal actually delivered a very interesting decision in respect of this circular. So the Concentrics and the Nestle cases are before the issue of the circular, but this Pune Tribunal is after the issue of the circular. And this is what the Pune Tribunal says in case of GRI Renewable Industries. The opening part, and this was dealing with the India-Spain DTAA, and the 5% was, with regard to the India-Portugal DTAA. So it says that the opening part of the protocol of the India-Spain DTAA, which is duly signed by the competent authorities, states that it shall be an integral part of the India-Spain Convention. So on notifying the convention itself, the protocol also is notified, and therefore there is no need for a separate notification of the protocol as required by circular number 3. Circular 3, which is issued by the CBDT, overlooks the plain language of section 90 subsection 1. As seen in juxtaposition is the language of the protocol, because treaties are entitled to give you benefit. You enter into the treaties to give you benefit, and you are overlooking that. So that's what the Pune Tribunal said, that is overlooking the plain language of the treaty. And notwithstanding this, circular cannot be applied, and this is important because sometimes, you will need to use this in some other cases as well. This circular or any circular cannot be applied for the period before the date of issuance. And in this case, it was in the year 2015-16 that the relief was being claimed. Circular got issued in 2022, and therefore this circular cannot be used, and therefore you cannot, be bound by this circular. So this is again some of the controversies as far as dividend and treaties are concerned. As far as beneficial ownership is concerned, this is what you need to actually do, when you want to claim lower rate of a treaty. First, check whether somebody is a person who is eligible to claim benefits under the treaty and is also a resident of that particular country. We have all the documents which we need, TRC, 10F, etc. Any declaration, undertaking, and in undertaking that particular person is a beneficial owner is very important. We all issue 15 CB forms. Please take a declaration specifically from the shareholder that it is the beneficial owner of the dividend. You cannot find out beneficial ownership, and therefore absence of this declaration is only going to put you in trouble, right? Prima facie, at least one has to have some indication of beneficial ownership, which is that, it is not a nominee or a trustee for anybody else. Check the register of members that that person does not hold it as a nominee of some other shareholder, etc. Then obviously also go to the limitation of benefits and see if the limitation of benefits specifically covers something like this, right? Typically, shell conduit companies do not come, or will get excluded by virtue of the limitation of benefits article. And of course, general anti-avoidance rules and MLI are always there. So you have to look at the structure in terms of the substance and then see, what you need to do. So, and the last issue that we will deal with is the DDT refund for the earlier years, in the year in which there was DDT. Now, given the fact that the dividend is to be taxed under the treaty at those lower rates, the question is that can the DDT, the dividend which is subject to DDT, which is 20% till it got abolished, can somebody who is a non-resident shareholder invoke the treaty and claim the refund, right? Because the language of the treaty is that such dividends shall also be taxed in the country in which they arise, but the rate shall not exceed 5% stroke 10% or whatever, or 15%. And therefore, if a 20% DDT is paid, can you claim refund to the extent of the 10 stroke the 5%? And the answer to that is that people have certainly tried. The matter is still under litigation. There are favorable tribunal decisions of the Delhi tribunal in case of GISEC and Deviant, and Texas Instrument, which is against. And Calcutta tribunal also is in favor in Petronas. But the Bombay tribunal has sent this to a larger bench in Total Oil. So we will have to see what happens in any case. Yeah. So with that, I think let me just end this. There are some decisions on dividend which I will leave you to read. They were just in this. This is my inspiration to deliver today's lecture. Do you know who this is? Jasprit Bumrah, right? We all know what he did. And therefore, somebody who delivers the last mile of this DTRC also can hit sixes. Thank you very much indeed.
So, sir, thank you.
Questions. The most difficult part. 6 weeks
So last ball पे 6 मारने के लिए sir, really thank you so much. So friends, if we have any question answers, we can take it.
It can be said that it is in the nature of business income.
Yes, it can. Yeah. But I would believe that there is a roadblock as far as 56 is concerned. As far as carry forward is concerned, I don't think there will be any.
Yeah, correct.
हाँ, मिल जाएगी. The answer is to all your questions. The presentation is yours.
Yes.
And so is the recording.
So, well, really, thank you. Thank you so much, sir, for this wonderful presentations. So friends, now the time has come to recognize for the contribution of our some senior members who have present today with the having 4-digit membership. So we just would like to felicitate them. I'll call the name. Please come up, sir. So first, I would like to call Shantilalji Rambia, sir. Having membership is in 4-digit 7670. Sir, please come. Sir, please come. Sir. Okay. Yeah, so I'm announcing the name. There are two person, Bhagirathji Ladda and Shantilalji Rambia. Okay. Yeah, please come, sir. Please come.
Thank you, sir.
Thank you so much for joining us. Thank you.
This is really the tradition that we have. This is what we get from our elders. The
Yes.
thirst to learn, at this age, at this juncture of their lives, they are still coming and learning topics which they would have learned all throughout their lives.
Yes,
So I think
and
hats off to you, sir.
And thank you, sir. We are fortunate that we are having your presence today. Thank you so much. 1966. My God. Even I was not born in that.
I was also not. I was born in 67, 1 year after.
Yeah. So friends, we have reached towards the end of this series. So for this, I would like to call our chairman, WRC Murtaza Kachwala, sir, for this concluding remark.
Thank you, Shweta. So let me first thank all the participants. We had about 173 physical registrations, and I could see many of you coming all 4 Saturdays. And we picked up only those 4-digit numbers who were less than 10,000 membership number, but actually less than 20,000 membership number are about 11 people, and of which 9 are present today. So to all the seniors, a loud round of applause, actually coming all the way here. So thank you for that. Thanks to all the participants physically as well as virtually. I think without you all, this conference was not possible. Second, definitely let us thank all the speakers. And of course, the last, Jasprit Bumrah today. So Anish bhai, really, thank you very much. And we really enjoyed. So each one picking up a subject and going into the detail and providing us all the clarifications and the nuances of those sections. I think extremely grateful to all the speakers. And all presentations and all the recording are also available, and we'll again circulate the link. Today, the first speaker could not come, but we have spoken to him. We were in fact telling him to take it from home, but he was really down with fever. So we will organize one session of his again, and we'll send the link to all of you and free of cost. And we'll not charge you anything, but we'll ensure that he also talks to us on the charitable trust. But of course, Ravi ji also, I think, did justice to the subject today. So thanks to him as well for accepting the invitation. And thanks to all the WRC staff. I think they relentlessly keep on doing work for us, and always from the registration team to the events team here. So extremely, extremely grateful to all of them.
So with that, and also to all the council members at the center at where the region. So thank you all. Thank you. And we end the session here. And anything and everything, we are always available at WRC. Any suggestions, any feedback, happy to take. And some suggestion come on one speaker, Sagar Tilak. He was talking about the litigation and enforcement directorate and etc. So, and there were some difficult questions which he was unable to answer from the podium. So we have agreed that we'll do a round table discussion. So we'll again send a message to all of you. If you want to join, please welcome. Sagar said we can do it next week or something. So on an evening, maybe 1.5 hours, and we'll all meet. So we'll send you a message on again WhatsApp. Okay, thank you. Thanks a lot. Thank you.